Yo, 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 what's going on, guys? It's Froggystyles here. We're going to be talking about covered calls today and how to make money while you're waiting for your squeeze to go off. Audio test for anybody that's on YouTube. Let me know if my audio sounds good, and then we'll get right into it here. I am probably going to do a text document so I can pull up the numbers. I need a third phone stand over here. So let me see here. What's going on, Hayden? How you doing, man? All right. Thanks for the thumbs up. I just wanted to make sure that I was clear because I didn't want to get in and start sounding all mumbled. So we're going to pull up a text document real quick so I can type in it. Because it's nice to be able to visually see what we're doing. So let me link it right here. There we go. Get the format set right. Should be good. All right, so since I don't have a whiteboard app yet, which I'm going to be working on so I can just draw it on there, we're just going to be typing it onto the notepad so you can actually see it. So what we're going to be explaining, there's different types or different things that you can do with your covered calls on how to make money. Now, one thing is if you have a long-term position and you've held it for over a year of any other stock, you want to, we'll type this one in as a rule. Rule 1, no squeeze play stocks. Just because if it squeezes while you're selling covered calls, you lose all the top end on it and you only make like 10% and that's it. Next thing would be, try to think here. No long-term positions. Because if you have a long-term position, and I'm going to put in parentheses here, 1 year or plus older, what happens is you do have a slim chance. I can't say slim, it's we'll say 15 or 20% chance that your shares will get bought from you at that marked up price. So when you go and mark your price up 10%, your shares can be purchased at that 10% markup, which would take it out of a long-term status into a short-term status, and it changes your capital gains. So for the safety of your play, no long-term plays over a year, just because of the fact that if you get caught just one time selling your position, it changes the tax implications of what happens to that stock. So I think that's pretty much all the requirements that I'm thinking of that's even important.
Well, how will a person do it then if they only have long-term positions?
Well, you can do a long-term position, but you have to be, you want to be even more safer. So, but you still risk the chance of getting, selling your position, and it's safer just not to do the risk. But then again, the payout kind of pays for itself in a short period of time too. I mean, it's up to you. Technically, it's not up to me. But for less risk. It's better to work with any stock that you've held. Oh yeah. You need at least 100 shares or more. You need 100 shares so you can sell a contract. You can do a covered put. So you got to have cash in the amount of the total shares for a covered put. So when you own the shares, from what I understand, you can't sell covered puts. You can only sell covered puts when you have cash in the same value. So when you sell your position, you can actually sell a put because you're sitting on the cash equivalent of those shares. So that's pretty much it. I'm going to write this here. 100 shares or more for a covered call, cash in the amount of the total shares, 100 total shares for the covered put. Now this is where this is like the most complicated part of everything. We're going to set up a new line here. Actually, I'll just say kind of rules, I guess. So we're going to go to the next one, the how-to. Actually, we'll get into what it does first. How it works. There we go. Okay, so how it works for a covered call is you sell the one contract and you get the premium money the day that you sell the covered call. So if you sell the covered call on a Friday, the money drops right into your account, and technically you're responsible for holding on to it until the contract ends, which in this case we're going to be setting for a 1-week contract, just because you don't want to get too wild and crazy and set it out like 6 weeks, because then you've got 6 weeks worth of basically sweating it to see if the stock goes wild one time and it messes the whole thing up. So we'll say Tesla runs up 10% once every 2 months, just as a hypothetical. Well, if you set up a 2-month covered call, there's a good chance it's going to run up and knock you out. And it will mess up, I can't say the majority of the play, because every day that's counted all the way up until that stock runs up 10%, you get paid for each and every single one of them days. So when it runs up, there's also a chance it's going to come back down. So if it runs up 10%, that doesn't mean it gets executed. But if you wait for it, it can come back down to where it's underneath your strike price. And then you'll still be in the game. And you still basically keep all the premium. Hey, there he is. We got the man.
Can you hear me okay?
Perfect, man.
I figured it out.
So we got Spence, Froggy Stonks. This guy is brilliant. He doesn't give himself very much credit, but he's brilliant. So,
thank you very much.
Now I don't have a fancy whiteboard like Trey and those guys, so I'm doing like the cheesy notepad type in text. So basically the rules here for doing a covered call or a covered put, and I should split them up because they're two totally different things. One's taking advantage of the red market, and one's taking advantage of the green market, or green candles or red candles, or however you want to look at it. But the rule is no squeeze play stocks. That should be right off the bat, because there's going to be people looking at, well, I got like 10,000 shares of AMC. No, leave those alone, because if they squeeze then you screw yourself. So you don't touch those plays. Long-term plays, anything with plus 1 year or more as a hold time, you get that lowered capital gains tax. And if you do any of those plays, you're at risk of knocking yourself out of a long-term tax benefit and going back into short-term. So that would kind of give you a little hose job. You got to have 100 shares or more. I prefer something that's cheaper in price, between like 5, 10, 20, because you can get to 100 shares quicker. You can do Tesla, but to buy 100 shares, I mean, you already know it's going to cost you some money. But the payout premium, and I'll do examples of like the payouts that you would get for different stocks and stuff. When you're doing covered puts, you need the cash in the amount of the 100 shares for the covered put. So that's pretty much how that part works there. Spence, have you done covered calls or covered puts? Oh, your mic's not working, man.
Can you hear me now?
Yeah, that works. I got you.
I personally have not sold any, but I've been thinking about it more and more with the way the market is. Since we're getting closer to the downside, there's certain companies I've identified, like Big 5 Sports, that is not doing well at all. It's shorted a little bit, but it's pretty heavily shorted, but it's not a good company as far as their business model goes. So I think selling covered calls on something like that's probably where I would lean.
Yeah, I was just looking today at Philip Morris, MO. Well, I mean, it's ATER now, but it doesn't look like it pays as good a premium. I think it's because a lot of people aren't swamping into it. So you typically want to try to make at least 1% per week on a covered call. And if you do that in a compound, it adds up pretty quick. Depending on the plays that you can get, you can still get about 2% a week, which sounds like phenomenal. But that's like 175% return on the year in compound. And that's what makes this strat pretty brilliant. But you want to play conservative. You don't want to play aggressive until you get used to it.
Yeah, I'm looking more at selling puts. I think there's still a little bit of downside to the market. I'm going to wait till we see that there crash, that real dip that we've all been expected. And when we see that, I've built my position up to where I'm going to play long for the next year.
Yeah.
But I'm going to be selling covered puts on the way up as the market's recovering, because historically, anytime we have a crash or a recession like this, we always see market recovery within the next 3 to 5 years. So
now we haven't fully taken a 40% dip. Oh, we got George Donahue here. Welcome, man. Let's give him the mic because he's a pretty smart dude too, and he understands this stuff. I seen your video on wheelhouse trading with calls and puts, like selling covered calls and puts. Loved it. I didn't even actually know that was a strategy, but it makes total sense. But since you understand covered calls and covered puts, it's a very easy income generator. So it's nice to have experience up here to talk about it. How you doing, man?
Mr. Donahue, unmute your mic. I think you have your mic unmuted.
Good afternoon. I'm glad to be here. What I'm saying is I think that the covered calls and the covered puts are a great revenue stream that's really, really secure, especially the way the market is right now. A majority of the stocks are way below their 52-week highs. So even if you're forced to buy them at these low rates, you still get them at a really great price.
You're right. Now, here's the thing that I was looking at. Like, I never paid attention to this kind of stuff like a couple years ago because I was all in a swing trading and doing options trading and stuff. But for someone like my mother, she's like up in her 60s. She had $425,000 and she ended up putting that in an account that gave her like 4.5%. And that's horrible. But this is a way that you could conservatively easily crush that.
Definitely. Once you pick the right stocks and you pick the right strike price, and a lot of people, some of you looked at the video. I think I did it like 2 or 3 days ago on the wheel strategy. It doesn't. The Greeks don't come into play because the way I put it together is short term on a weekly basis. So the Greeks, the theta, and the delta, and all the other stuff doesn't come into play. And because the market has been suppressed so much over the past 6-7 months, the covered calls, the covered puts, selling them, you're almost like the hedge fund in this situation.
Exactly. Like you're the one making the money, the income, low risk, and all that stuff. So it's like I said, it's brilliant.
Right. And what's great about the puts is if the market keeps moving sideways, if the market keeps moving sideways and you're selling those covered puts, you're just collecting premium, and you never even have to buy the shares, because as long as it's not exercised, you just keep collecting those premiums every single week.
Yeah, right now with the market dipping, selling covered puts would be a smart way to go, just because of the fact that you get to pull your money out and preserve it. Then you sell covered puts, and then you could just keep adding to your cash position, and it's a win-win for you because you take the risk off the table.
Exactly, but the thing is, you want to pick the right stocks. You want to pick the right stocks and pick the right strike price. That's the hardest part. As long as you pick the right stock with the right strike price, I mean, it's a great opportunity to generate weekly income, and it'll be way better than 4 and 5% that your mother's getting on her $425,000.
Now I'm going to have to teach people one Greek. It's called delta, because delta is basically like the percentage chance that you have of that stock going into that strike. And
right, exactly.
You usually want to go for something between 25 and 33% delta, just because of the fact that it's a really good chance, the odds are in your favor, that you get to keep all the premium, and that's exactly what you want.
Right, but the current state of the market, I don't really think the delta comes into play that much when you're doing a weekly option. If you do the option on a Monday with an expiration date on Friday, the delta doesn't really come into play that much. It doesn't come into play that much because the market is on a downward trend. So if you sell a covered put, like the one I had used in my example was Riot. And Riot is currently trading at about $460, $470. If you sold a $5 strike price for June 24th, you'd make about $70. Is it really going to go to $8, $9? Or matter of fact, is it going to fall during that time? Because once you sell the covered put at a $5 strike price, as long as it stays $5 and below, you keep the premium and you keep your collateral. So right now, the way the market is in a downtrend, I think the covered puts a great opportunity to generate money every single week, and that's what I've been doing with them. I've been doing the covered puts because of the way the market's running right now.
But what is a strike? What is a strike? Some of us don't even know what a strike price is. I mean,
a strike price is a price that you have to purchase the stock at. Each contract is 100 shares. So if you pick the $5 strike price, what they're going to do is they're going to take $500 and freeze it in your account as collateral. When you're selling the put, you're saying that if it reaches below 5, you're obligated to buy it at $5. So if it drops to $4.50, you still have to buy it at $5. But if it goes up to $5.50, $5.60, $6, then you just keep the premium and you don't do anything. And they release the $500 after 4 o'clock on the expiration date.
Right.
I did a video on it. If you go to my YouTube channel, where I explained it in a little bit more detail about 2 days ago.
I'm gonna link it right.
It got like 3,000 views, so I think people are really looking at it.
I'm gonna link it right now for you. So this is that wheelhouse trading.
Right, exactly. That's a real strategy, and I really think it's a great opportunity. I'm not telling nobody what to do. I'm not telling anybody what to do. This is not financial advice. I'm just telling y'all what I'm doing.
Spence has got a question. Go ahead, Spence.
Well, it's more of a thought. George, good to talk to you, man. I'm a fan. Glad to know that you had a YouTube. I didn't know you were on there, so I'm going to follow that. Love all the work you've been doing, man. You put your money where your mouth is, that's for sure.
The thing is, what they've been doing, has been allowed to do, is outrageous. And the SEC, they know what's going on because they've been finding them for the same actions for the last 20, 30 years. Naked shorting isn't new. Trading ahead of us isn't new. Everything that they've been doing, they've been paying fines for doing the exact same thing that we're accusing them of for the last 20 years. The thing is that the fines are so minuscule that it just emboldens them to continue breaking the law.
Yes, sir.
And that's the problem. Nobody ever goes to jail. I mean, if I steal $1 billion and you find me $20 million, am I going to stop stealing?
Well,
right.
and that's really where I think we're at. That's where I think we're at. That they're able to steal a large amount, and the fine is a small percentage of what they stole. So they just keep stealing every single day. But the only thing is that we caught them with their hand in the cookie jar now, and everything's been exposed.
well,
So I don't think they can do it for too much longer.
Totally agree, man. Totally agree. My thoughts on this covered call stuff and what I've noticed is, me personally, and of course not financial advice, I think there's more room to the downside on the SPY. And my theory on this covered call stuff is, you want to try to find what I'm going to do is I want to try to find a stock that follows the SPY pretty heavily. That's not a squeeze play. You know what I mean? Because then you can get in on these covered calls relatively cheap. But if we see another 20, 30% downside, that's a good opportunity to make some profit in the midterm while you're waiting for your squeeze play to work out. Because I think that the Dow and the IWM have already bounced the pre-pandemic high. The SPY still has about 30 points to go before they hit. We drop back down to that pre-pandemic high, which I think then things are going to get real nasty. And if you're into some covered calls at that point in time, whether you're into puts or you're selling covered calls on the SPY, I think you're in line to make some good money.
Well, let me ask this question. I'm just asking a question that people will want to know. How do you go about finding the stock, though? How do you go about finding that? Because most of us are AMC or GME or long-time holders. So how do you find a stock that can make this type of money?
Well, here's a couple of things that you do want to do. Look for a stock that is either not moving up or down, that's kind of going sideways, and you could pick either direction. You like high IV stocks are good because they pay out more in premium. Usually where there's a lot of people diving in and buying calls and puts, those are attractive because it's easy for you to sell to them, and that's where the market maker is cleaning up. Like if you use Tesla for an example, I'm not saying that people want to go out and buy 100 shares of Tesla, but it's a good one to use as an example. There is a ton of buyers in there for calls, puts, shares of stock, and the premium isn't like super amazing, but it's still pretty good to where it's respectable, and you can still get stock growth from it. So it's a longer term play. You know Tesla's going to be around in the future. I do like that one for selling covered calls on. But with the market going down right now, again, pulling out and just selling covered puts on that one would probably be a smart idea too, because when it's going sideways, you can make money on covered calls or puts because neither one make money for the people buying them.
So it has to be going, my question, so it has to be going sideways? Is that what you guys are saying? Or sideways in order to make money? I'm lost.
You're gonna make the premium. You're gonna make the premium either way. The minute it's sold, the premium goes into your account. But what are you talking about? What trading sideways? If it's trading sideways, it never gets exercised. So you're never forced to buy the shares, or you're never forced to sell your shares, and you just keep collecting the premiums if it's running sideways.
Yeah.
Okay. This guy named Tendie Time has
Yep.
a question. Mr. Tendie Time.
What's up, guys? Can y'all hear me?
Yep.
I'm down the road. All right, yeah. I just got this thing about. I was on the YouTube channel and I put in the comments. I made a mistake. But for starts, I would look. Blue chip stocks are good places to start looking, in my opinion, for covered put. Warren Buffett. Just an example. Warren Buffett, a long time ago, Coca-Cola was at $39 a share. We bought a whole bunch of $35 put, and we made, I think, $7 million immediately. And that's what I say. I think start looking at like blue chip stocks that have very little movement, and people want their insurance policies to protect their money. I appreciate every one of y'all on here. That's all I got.
Thanks, man. So we're going to do an example real quick. We're going to pick a company. One that
Can you do Apple? Do you mind doing one like Apple? Because Apple is a blue chip stock. Do you mind doing Apple? Because I know you like Tesla, but I want to see if it would work on Apple.
Well, we picked Ford just because of the fact that you kind of want a low price stock, so it's easy to get in to get one contract to sell. So we're going to use that one first, just because of the fact that. So we're going to do Ford, not Frog. My bad. So it's going to be ticker symbol F. Let me make sure you guys are seeing this.
I'm long on frogs.
Yeah, me too. So let me go and look up the price on it, and I'm going to get into the option chain real quick, and then I'm going to pull up some numbers and show you some stuff that will shock you. Because I was not planning on doing covered calls or puts until after I got over $1 million, and I realized you can do it with 50 grand and still make a very good second income, like easy. So
Exactly.
So right now Ford is trading at 11.24, and then we're going to go into the option chain here so I can see what next week looks like. So we're going to take, we'll just take 100 grand. Because some of the people have 100 grand, but this theory about needing $1 million to retire, this might debunk that idea. So we're going to do 100,000. Let me put a dollar sign on there. Probably don't need it, but so what that's going to give you in shares of stock, let me find my calculator here. That's going to give you 8,888 shares. So, which will equal, if you just divide that by 100,
88 contracts.
it'll give you 88 full contracts. It's actually like a partial, but you can fill that in with your gains and get to your 89th contract. So now what you're looking for is a strike price. We're going to be doing covered calls just to keep it simple. So I'm going to go into the option chain, and your strike prices are actually set up every 50-cent increments. So what I'm looking for is we're going to do just a quick, this is just as basic as you can get. You take the stock price and you times it by 1.1, which will be 10%. And that will give you a total of 1236. You can round that down or round it up. I'm just going to round it down to 12 strike. And we're going to see what that would end up being. Actually, I think I'll round it up to 1250 just because of the fact that play it safer. So at 12 strike for next week contract. So we'll call it for June Actually, I'm going to have to write this up for a 1 week contract for anybody that does see this video in the future when this becomes out of date. The premium equals, it's only 5 cents, so you get $5 per contract. Ford is a kind of a bad example, but still, you're going to take 88 contracts and you're going to times that by $5. And that's going to give you $444. And that's just for 1 week. That's actually not bad money off of having 100 grand. Now keep in mind you still got to pay tax and whatever on that, just like anything else. You can also reinvest that and buy more shares. And if you bought a couple more shares, you can get up to that 89th contract, and the next week you can get more. So with $440 divided by 1124, you're getting about 39 shares per week. And you can just keep adding contracts, and accumulating to your position. And it goes into a compounded kind of thing. You could probably get more risky with it. That Ford is a very low paying one. Where's the 30%? Oh yeah, they're terribly low.
Take a look at Riot.
And see, this is where people during this call, if you're trying to learn, you should be set up on a paper trading account doing it with Froggy as he's explaining this right now. Like Thinkorswim has a paper trading account. Froggy, I actually just put in that covered call on the paper trade. So next week after expiration, we'll come back and take a look, and people can understand. Win or lose, it doesn't matter for the example. People can look at the example you just did, and we'll see the results of it too.
Now, let me move this one down. This was at, let me see, a covered call, 10% markup. So that's all that was a 10% markup. Now I'm going to turn around, and those are two separate things. This is actually one deal. I'm going to do another one. It's going to be a covered call with a 5% markup, and this is getting risky. This is where you don't really want to. You gotta know your stock before you start getting into the 5%, because 10% is 2% per day. 5% is only 1%, but it's going to show you how there's a change of going from, and I recommend 5, 7.5, and 10% markups, and it's each stock is going to be different. If you got a low volatile stock, 5% might be safe. If you got a high volatile stock, 10% might be safe. So, and then we'll do a covered put just to check it too. So we're going to take the 1124. We're going to times up at 1.05 because that's where you're adding 5% to your 100% of your total. Comes with 1180. So obviously you gotta kind of round it up or down. I'm going to round it up to 12, which is a little bit more than 5%. It's probably closer to 7%. So we're going to put a $12 strike, 1 week. Premium of, and this is where you get $9 for the contract. So it's a big difference. Just by changing your strike a little bit, you just went forward 50 cents, and now you're gaining $4 extra.
per contract is just $4 extra.
$4 extra per contract. So that's going to be $792 for a week. That's a much better pay, a little bit more risk. Like I said, I'm just going to mark that at 7% because that's pretty much what it is. I think this one here is probably closer to 11 or 12, but let me double check it to make sure. Nope, it's 11. And then this one here is basically 6%. So as you can see, the pay differences, there's a big difference based upon your strike. If you're greedy, you'll move in too far, but there's a chance that if it goes up to 12, all the shares you got will be bought at 12, which would be a 6% markup. Instead of getting your $7.92, you'll actually get paid 6% on your shares. Now, that depends on what day of the week, too, because it divides out. If it happens on a Friday, you get 6%. If it happens on a Wednesday, you get like 3% because Wednesday is half the week. So that number would divide out. We'll go back to 5 just because it's easier to calculate, and 10. So we'll say if your contract gets executed on a Monday, since 10% divided by 5 days is 2% per day, on Monday, if it gets executed, you'll probably only make 2%. And 2% on 100 grand is actually about $2 grand. So you'll still get paid more than what you would have got from your premium. So it's actually not bad to get knocked out, but there's a little bit of complication.
No. The way it works is you, even if it's exercise, you still make the 6% and you still keep the premium. You get both.
The premium stays regardless.
Right, the premium stays regardless, and if it is exercise, you get that 6% increase on your shares for that week, and you still get the premium. So you're getting paid twice, and that's if it's exercise.
Yeah.
So exercise means that it hit the price?
Right, and you
okay.
And on a covered call, that means you have to sell it at the strike price that you chose.
When you make that contract, it's an agreement that you will sell for that price. And looking at Ford right now at 1124, if you have 8,888 shares of Ford, you have an agreement that you will sell all your shares to that person at 1250 when it hits it. So if it hits it Monday, Tuesday, Wednesday, or sometime during the week, if they execute it, they're paying you $12.50 for all your shares. So that's an extra $1.25 per share that you agreed to sell them at. So you are almost, I don't want to say guaranteed profit, but that's almost exactly what that is guaranteed profit.
And that's when we talk about not doing a squeeze play. You don't want to be selling covered calls on a squeeze play, because if it goes up $30, $40 past the strike price you agreed to, then you're losing that money out by not having your shares anymore if that individual on the other side of the contract exercises.
Yep.
Exactly. That's why I don't do it with AMC and GME. I don't do it with AMC and GME.
You're a smart man.
That would be crazy. I do not do it with AMC and GME.
So if for some reason Ford got lucky and somebody wanted to buy a bunch of Fords for no reason, and it decided to go to the moon, which would be impossible, and we'll say it shot up to like $30, you would only get paid $12.50, and the other person would execute them shares and buy you out at $12.50, and you miss everything above $12.50. That's the only negative, is you're selling future profits that you've never received.
Hey, Frog, I think that you lost a bunch of people by going 88 contracts. If I could say something. All right. One contract. You would have to have 100 shares of that stock to sell one contract. You would collect the premium. If it hits the strike price, you keep the premium, you sell your shares for a profit. The covered puts is pretty much the exact opposite. You don't need to have the shares. You got to have the money to buy 100 shares per contract. And basically, you don't want it to be exercised. You just want to collect the premium every week.
Yeah.
In my opinion.
You're exactly right. In the covered put, instead of buying the stock and holding the asset, you actually just hold the cash equivalent of the shares, and you sell the premium, or you sell the contract, and you make the premium that way. So typically, you sell puts in a downturn, like a downtrend market or a bear market, like what we're in now, and you're actually saving money by sitting out, and then you just sell the puts.
And you have all that money ready to jump in when it hits the bottom.
Exactly.
You know what I think is smart about Ford is, one, it's a pretty stable company. For the most part, it hasn't had a lot of volatility over the past 10 years besides crash scenarios. They're selling out of their pre-orders on their trucks, but the problem is they can't deliver because they're still having the chip shortage problem. Yep. So for that time being, covered puts on Ford, or not covered puts, covered calls on Ford is probably a good idea, because anybody buying those call contracts, we're probably never going to get real close to the strike prices that you're going to pick, depending on what you're trying to make. So that would be my pick personally, is Ford. Unless they come out and say, hey, we found a bunch of chips in a warehouse in Utah or something, I don't think they're going to see a big price shock anytime soon to the upside.
Well, typically you want to look at your trend on market, and if the market looks like it's downtrending, you get out of the stock, preserve your wealth, and then sell covered puts. So you're still making money, but when the downtrend turns or it comes off the bottom, you can even look at your weekly trend to be like more steady. And when the weekly trend starts trending back up to where it's going in a positive direction, you want to sell covered calls and be in the play. When it looks like it's trending down, you want to be out of the stock, into the cash, and selling covered puts.
Okay, so you saying sell covered puts when the market's going down, and cover sell? Okay, are you saying sell covered puts when the market's going down? Sell cover. Oh Lord, wait a minute. Are you saying sell covered calls when the market's going down, or sell cover puts when the market's going up? What are you saying? Okay,
this is how I remember calls and puts. Like, you call up your friend and you put down your enemy. And so when you're putting puts on something, you're expecting it to go down. And when you're calling up somebody, it's usually, like I said, it was a friend. So when you call, you're expecting it to go up. When you're doing puts, you're expecting it to go down. When you're selling covered puts, you're actually forced to be in cash only. And we lost George Donahue. Where'd he go?
But when you're selling covered puts, you don't really want it to go down.
Yeah, you want it to go up. Covered calls, I think we just got mixed up there real quick, Froggy. If I'm wrong, somebody tell me, but if the market's going down on a trend, I would want to be selling covered calls, because chances are that strike is never going to make it, so the exercise will never happen. And then the person buying the call contract would be losing their premium to me. Am I explaining that right?
There's a catch-22 on that. You got to remember your asset is still at play. And if your asset's, like, if you're selling covered calls while the market's going down, your asset's going down faster than your premium, you are preserving your losses that way. So, I mean, you could do it that way too. You could just sit in and just sell covered calls all day and not even pay attention to stock direction and just absorb losses with the market. Because, like, right now, with the market being in a bear market, you could just be holding and selling covered calls the whole time and offset the losses to the market. So when it does come back, you're still accumulating. So, I mean, there's two different ways to look at it. Neither one's wrong. That's the thing. As long as you're selling premium, the way I do it is, when it's going up, you're in a position and you're selling a covered call that's out of reach. You can get hit, but your main position is still growing, and you're just basically setting a range where you think it's going to go. Sureg, floor is yours, man.
Okay, this is ignorant. I know it's ignorant. So I don't know. Everything's covered. You got a $10 spot, doesn't matter what the ticker is. Can you sell $12 covered calls or $12 calls because you own 100 shares and you think it's going to go up, but you don't think it's going to go? Do you see where I'm going? You're going to have to think, because this is, I'm floating in a damn swimming pool.
Froggy's talking about collecting 2 times. He's talking about collecting the premium and basically picking a stock that he's hoping goes up a little bit, where it doesn't go so much that that you make the most, where it only moves up a little bit and it hits on a covered call. These are not covered calls. Covered puts are not the same as buying calls and buying puts. You're selling, you're not buying.
Well, I want to sell a call that's $2 out of the money because I think it's going to go up $2.20.
Okay, and if you did that, you would get a premium for whatever stock you did. You would get a premium right from the very beginning if you own 100 shares. And if it goes, then they would be able to exercise it, and you would sell your shares for $12 a share. You would sell 100 per contract. If it didn't, you would just keep your the money they give you in the beginning and just rinse and repeat if you wanted to, or do something different. And also, we're not telling anyone what to do. We're saying these are things you could do.
Well, that's why I asked the question if it's not covered, because everything being said is covered. Well, what if I want to sell something and make more premium that I think it's going to go up?
Then you're just going to buy a call, and you're hoping the stock goes up, and you probably just sell the call contract itself. That's where you're buying initially. You're buying a contract. When you're covered, you're selling a contract. You're not ever buying a contract. You're selling the contract. You're selling the insurance. Either way,
gotcha.
Selling the insurance to people is
Now,
is an easy way to call it.
The idea
Okay, Jeremy, what's the difference between because I heard you guys say premium, I heard you say strike, puts and calls. What's the difference between what's the premium?
The premium is actually what you get paid for the contract. They give it to you for actually basically writing it up. And
Okay, so the premium is what you get paid for, you saying? I'm writing this down at the time. Is that what you're saying?
So, Diva, if you sold a covered call and Froggy bought it, Froggy would be paying you a premium for buying the call that you just sold him. You know what I mean?
I'm right. I'm writing. Okay. Now, and the strike is what?
the strike is the agreed upon contract agreement. So it's basically like, did you guys ever see one of them memes where someone's holding a carrot on a stick and they're saying, you were so close, but you almost made it, but you didn't quite get it? Like the Super Bowl, memes and stuff. It's the same thing. You want to set a premium price that you don't think the stock will make it to that week. And when it doesn't make it there, all that premium they paid up front for that contract goes right into your pocket after 1 week. So it's basically like you say, well, I'll sell you 100 shares if it gets to $12.50, and then you got to pay me the 11% markup to get them, which, I mean, that's a win for you in the first place. If it doesn't get there, then you still pay me $440. So,
all right, look, let's try it like this. Say if you're buying a house, you're looking to buy a house, right? And you have to pay the little thing that you give the woman to, I can't remember what it's called, but that is your premium. You're selling the house, you get the premium, period. And y'all come, you basically tell them, hey, you want to buy the house for $200,000. If it gets to $200,000, that's the strike price. If it gets to $200,000, you'll buy it at that price. But say it's currently $210,000. You're going to keep the premium, period, point blank, on either one, the put or the call. You're going to keep the no matter what. You have to sell them your shares for that price. If it hits the strike price on a put, then you have to buy their shares for their agreed upon price.
Why don't we do a person-to-person example, Froggy? Like, I have shares of Ford in my account right now.
Okay.
Right? I own Ford. I have 100 shares. I'm going to sell one covered call out to the open market, and I'm going to pick the $14 strike price because we're sitting at what, like $12.30 right now, $12.50.
They'll give you
so I'm going to
$2.
Right. I'm going to sell one covered call of Ford because I own 100 shares out to the open market, and I'm going to pick the what did I say, $13 or $14 strike?
14.
14. Now, if Froggy wanted to buy that, he's going to have to pay the premium to buy that covered call. Froggy's, I'm selling it, he's buying it. He's going to pay a premium for that covered call. Now, if it goes up to, if he buys it and it goes up to, say, $20, then he's going to make a lot of money because he can come back and exercise, which is to buy those 100 shares at the strike price that we agreed at in the contract, which was $14. So now he's buying shares for $14 that are worth 20. That's if he lands in the money above the strike price. Now, if it lands at like $13 and he doesn't want to exercise because it's going to cost him $1 more, then what's going to happen is the contract's going to expire. I'm going to keep his premium, and he's not going to get any shares, and I'm going to keep all my shares. Now, if he exercises, I'm still going to get the premium. Does that make sense, Diva?
Yeah, I'm following you now.
Okay.
Go ahead.
So I wrote it up right here so you can visually see it. Here's a 14 strike, 1 week out contract. Premium pays $2. It's 88 contracts for 100,000. That'd be $2, which is only $176 for the week. And that's still not bad money, seeing that this is technically not a retirement account at this point. You're being ultra conservative. And if you look at it, I'm going to type it down here too. One of the Greeks that a lot of people don't talk about is this thing called Delta. And Delta is currently sitting at 0.03. Actually, we're just going to say it's 3.8%, which is 0.0385. So when you go and look up your Delta, it's 0.0385, meaning that it's 3.8% chance that he's going to lose his shares, which means I would have to pay him $14 a share, which is currently trading at $11.24, in order to get his shares from him. And so he has a slim chance of losing his shares, and I don't really make much money at all. So the only person that's really winning is the person selling the contract, which would have been Spence, because he would love to make $14 for that contract. So he's probably like, he'd be excited if I executed that. Now, if this stock went to 20, he wouldn't get $6 per share. I would, but other than that,
And I would still make money. I would still make everything included in selling that covered call. I would be a little upset that it went to 20 and I didn't sell my shares at 20, but I still made money regardless. And the chances of that going to 20 is not very good. So
now there is a question here that popped up. This is Casey Shaw. It says, don't forget to mention who is responsible for paying out a closed position. Now, typically on a Friday, I like to close the position out so I don't have any risk on it. But with a $2 premium, I mean, you're kind of just better off just letting it burn out and go to zero. But it does automatically just completely go to zero at some point when it's that far out. And but I typically, when it gets down to like a penny per share, I like to close it so I don't have to worry about it taking money back from me.
when just for everybody, So you're talking about closing your position out as the one buying the covered call, right?
No, when I sell a covered call, when it gets down there to where it's like basically 1 penny or like $1 for premium left, I usually close it out so I don't have to worry about it taking anything back. And I can, that usually happens on a Friday at like quarter till or whatever. It's at like $1. I usually just close the contract out, and then I turn around and I resell more shares for the following week. And then you start ticking more premium from Friday at quarter till, and you get that theta decay that rolls over in the next week, and it pays more than that $1 you spent.
So what happens if, say you bought the covered call we talked about, and things aren't looking all that great for you, correct?
Right.
Like you're like, oh man, I don't know if this is going to work out. What can you do with your contract that you bought besides exercising or just letting it expire?
There's nothing you can do. You just basically you've already handed over the money. I can't go and ask Spence, hey, this is not looking good for me. Can I have my money back? My money's gone as the purchaser of the covered call. And basically, I just write it to zero. It's by force. He makes all the money and just basically pockets it. And that's what the market makers are doing to people. And that's why we said before, no options may, because the market maker is selling thousands of options, making tons of premium. And then when they got that money, they can actually sell shorts and hold the price down so you can't go in the money. So then you can never take their premium from them. If Spence had a lot of shares, we'll say BlackRock and Vanguard, and he sold all of his covered calls and made a whole bunch of money, he could go and set up and sell shorts up there at that certain level to make sure that his premium is protected. But with these little plays, he's not going to be able to do that, but it's still the same concept. You get
go.
You get the money as soon as you sell the contract. Like for some reason, it deposits immediately. So you can buy more shares right now if you wanted to, or you can just sit back and basically kind of watch your investment until the very end and then just make sure it plays out. It dies off the way it's supposed to, and you get to keep 100% of the premium.
And you noticed Goldman put out a report after we did No Options May. Goldman actually put out a report saying there was a 70% reduction in retail investors buying options. And it's really interesting that they did that. And a week later, you saw Ken Griffin on live TV going, wow, retail's not selling, with an extremely worried look on his face. So it was very successful little thing we did there.
Yeah, if more people were, because you figure if you're selling premium, you're also competing with Ken Griffin and those market makers, and you're taking the money from them instead of letting them take it from you. So we'll say me, Spence, Diva, Tendie Time, we all want to go and sell covered calls. We're competing with the market maker, and instead of them taking all the money, we get to take some of that money too that's sitting out there, and we get to reinvest it and add to our portfolio where that market maker is doing nefarious stuff. What is that?
According to Hayden, he says, and Hayden says in an up market you want to sell puts, in a down market you want to sell calls. So that's bearish selling calls and bullish is selling puts. See what he's saying? He says in an up market you want to sell puts, in a down market you want to sell calls.
Well, I personally like to sell calls in an up market because I'm actually invested in the stock too. So then when the market's going up, I'm gaining value while I'm gaining premium. I just got to play it a little bit more cautious. And that's where that 5, 7.5, and 10% markup comes from, is you're basically putting that carrot out there further. But when you're sitting on a main position, we'll say I have a bunch of Tesla and it rips up $50. Well, that makes me more money than my premium. And so that's how I make money. When the market's going down, how you make money is by not losing it. Remember Elon's saying, which is, how do you make a small fortune? You start with a large fortune. But when the market's going down like it is right now, typically you go back to cash and you hold it there and let the market devalue itself while your cash maintains value, and you sell the put to make the premium to add to your pile of cash. And then whenever you find that bottom, you dive in, you buy the stock, and you sell the calls, and you ride it back up. Now, each person will have a different point of view on it. Supposedly selling covered calls is actually bullish. I think that is actually kind of right now that I look at on how it's worded. And selling covered puts is actually bearish because it's technically more effective, in my opinion, selling covered puts in a bear market because, like I said, your initial investment is being protected by being out of the play. So you could buy back in when it dips.
Swing Trader's has a question. Been having his hand up. Swing Trader.
Yep.
Yeah.
Go ahead, sir.
Yeah, thanks for having the space. The one thing that I'd mentioned for people doing this, looking into this and looking into the exercise, you gain a lot more money if you're looking at a stock like Ford, as the example that we're talking about, that's pretty stable. You make a lot more money going 14 or 21 or even 28 days out. If you look at the curve of theta, it really picks up at 30 days. If you sell calls out 90 days, yeah, you make more. You definitely make more money for the same strike. But the theta decay really increases 30 days out, starting 30 days out. Yeah, doing weeklies is uber safe. But depending on the position and depending on the stock, if you're looking at a very stable stock, you may want to think about going further out in order to collect more theta in general, because you'll get paid more handsomely selling stuff further out in the curve. So anyway, just my 2 cents on that. Looking at the Ford example, you can make twice as much money, more than twice as much money at the 11, going 11 days out versus the 4-day out option. So anyway, just something to think about and play with as in your demo accounts as recommended.
No,
versus Wall Street is in the channel. So when you want to see how much versus Wall Street is in the
I got him.
chat. Mm-hmm.
Now he is right. If you go 4 weeks out, you do get paid more. But from what I'm seeing, it's a ratio. So if you go 4 weeks out, you do get 4 times the pay. But I like to do it in a weekly fashion. Each person can do it on their own, on like how they want. They can do 1 week, 2, 3, 4, and check and see the payout. Because if you look at the 14 strike on Ford, where we got $2, and it's going to be actually kind of a tougher sell. On 4 weeks out, you get $7. So it might actually be hard to sell that contract at $2. Where 4 weeks out, you could probably definitely sell it for $7, because that $2 is probably actually $1.75, and you'll probably not be able to sell it at that price. There's a weird thing with the market on pennies. They force you to round things in a certain way that's kind of weird. But you look at the 12 covered call here, 4 weeks out is $36, so it's basically 4 times higher, and you could probably sell it at 9, and you could probably sell it 4 weeks out for 4 times the price. They both do work in a proper ratio, so either does seem like it's very effective, and they both would work. I prefer to do weeklies because I like to be more hands-on, adjusting it, so if the price does go up 5% this week, I can still mark it up and stay like, I keep wanting to adjust my carrot because I don't ever want it to get eaten. And that's pretty much it. Go ahead, Bobby.
Hey, what's up, Froggy? If you will, could you look at fuel cells? And could you tell me if that would be a good example of the strategy you're talking about today? Fuel cell, FCEL.
Yeah, let me. I'm gonna open up another tab for that one so you can. We'll do fuel cell. What is it currently trading at? Do you know?
Let me see here. I'll pull it up right now. Here, it's 340 trading at $3.46.
All right, give me a second here. Wow, that's weird. I just duplicated a file. What is that? FUEL?
FCEL, Frank Charlie Echo Lima.
Gotcha.
Hey, Blue Boy, what's going on, Blue Boy? I see you. Papa Stone Tree, what's going on with you? I see you. Hey, Mike, what's going on? Zach, what's going on?
Yeah, the reason
hey,
why I mentioned that one, Froggy, is for the people who have a tighter budget. That's what, and that will, I'm included in that bunch.
All right, gotcha.
I mean, you can use, as long as it doesn't move that much. I mean, it can be used on stocks that don't move that much. When you're doing it, you're trying to find stocks that don't move that much, that aren't that volatile. So if you're trying to make a premium, but like how Froggy's saying, if he's trying to double catch him, basically, if you was doing it the opposite, if you was buying the put, like say if it was a stock that was $10, you're trying to sell covered put at $8, collect that premium, sell them covered put at $8. What Froggy's trying to do is basically sell a covered call. Let's say if the stock's $10, he's trying to sell a covered call at $12. Collect the premium, and it gets to $12. Cash it. He's gonna sell his stock, cash in, then sell another one for, if depending how it's going, sell another one for 10% more to keep cash in. So it's a bunch of different ways to trade these kind of strategies. One thing I recommend is using the ATR indicator. I think it's called the average true range. When you figure out how to use that, it can change the game immensely.
All right, so we're going to be showing you this one here in the same format. So we got fuel cell up here, and we're going to be looking at the price, which is currently trading at $3.47. Helps if I give it a dollar sign. And then we're going to do the same idea, $100,000, just for an example. And then we're going to figure out how many contracts that is. That's 28,818 shares. Which is going to end up being 288 contracts. And then we're going to be looking at the different increments and see what's available for us. So I'm going to go into the 1 week option chain here. So first thing we're going to be looking at, 350 is actually going to be very easily achieved as a strike price. So I would avoid that one at all costs, just because of the fact that that could go into money in 3 pennies. So we're going to look at $4 as the first one. And that's going to give you a delta of 18%. Well, we'll just say, yeah, it's 18%, which is 0.18. So you had an 18% chance of that going into money. If you did a markup on that, 3.47 times that by you add 10% to it, it gives you $3.81. So you're way past 10% markup. So to me, I think $4 strike is very safe. Now we're going to go and look and see what the premium is on it. The premium on that would be $5. And then you do that with 288 contracts times your $5.
So he has Spencer's one. He's been raising his hand while you're still.
No, finish up. I'm just doing a placeholder. I got a comment after he's done.
So that works out to be a lot more money, but you got to make sure you can sell that contract at 5, because once you get down to them pennies, these contracts get funny to where they only let you sell them at a rounded number. But still, that's a good pay here because you get $1,440 for a 1-week contract. That's not bad at all. So if you have $100,000 and you can get this $4 strike contract to sell at $5, that's what it's currently priced at. You wait for 1 week and you can get about $1,440. And that's not bad at all. And like I said, the idea of having to have $1 million to retire, I'm pretty sure everybody could live off of $1,440 a week, or ideally live comfortably. But that would be kind of a second income if you wanted it. But I would just put it back in and buy more shares, because if you took that money divided by 3.47, you can buy 414 more shares, which is 4 more contracts, and you can keep accumulating to your position. Spence, you're next.
I just back on the point where you were explaining the difference between selling covered calls and selling covered puts, the differences between the up and down market. I would just say one thing. You could probably make a little bit more money by selling a covered call in an up market on a more stable stock, but you're going to increase your risk of your contract getting exercised. So if you do that, you just need to be prepared that you're going to potentially lose your shares. You're going to make money off of it, but you might lose your shares at that higher price. But like Froggy said, if you come within $2 or $1 of the strike, or say whatnot, and they decide not to exercise, you're making money on premium and keeping your shares. If they do exercise, you're making the extra money on your share and you're making the premium. But you just do run an increased risk of losing shares. And if there is any type of overall, if there is a market, everything squeeze scenario that they've been talking about, I'm not sure it's going to happen with a company like Ford, but just be cautious of that too, because if this market does squeeze out completely, it could be rough for people who are doing that. But you are right on, you could make a little bit more money doing it that way.
No, and it's not that you lose your shares. You actually sell them for the marked up, agreed upon price. So you're actually, like in this case, you paid $3.47 for these shares, and if it goes up to $4, they pay you $4 per share.
Right.
So, and then there's a good chance you get to keep that premium on top of it because you already have it. So that turns out to be kind of a win-win scenario. I know that the variables aren't 100% exactly like, you'll probably get like 96% of all the actual numbers that you figure, but still, it's still really good because the risk is low, and you're making way more money than you could if you let somebody manage your money for you. Because if you had $100,000 and you said, I want to retire with that money, which I don't think anybody would be able to retire with $100,000, they'd give you 4%, we'll say 5% generous. And that's only going to be $5,000 for the year divided by 12 months. That's $416. That's a joke. And that's how people are getting screwed, is the money managers aren't doing anything beneficial for you. Where this here, you learn a skill. You can do this with any stock. You basically want one that your main investment doesn't go down, because you don't want this 347 to go down while you're making money here. You want a play that you know is going to be around in at least a year from now, that's going to continue to grow, unless if you're expecting it to go down. That's why I said you sell it, go back to cash, sell the puts. I mean, you can sell puts on all of them and never invest in the market, and you're almost, I can't say guaranteed to gain, but you're guaranteed not to lose anywhere near as much if the market's going down. So you can sit in cash if you wanted to and play the same strategy and not worry about your initial investment getting hosed by the market.
Okay, Doug later has a question, but did you get that link to 8 versus Wall Street?
Yeah, he's in here.
What's up, Ms. Harris?
Okay. Doug Nader has a question. Go ahead, Doug Nader.
Thanks, Steve.
Yeah.
Okay.
Would you only do this on stocks that you're already in the green on, or is it worth taking a chance if you're bag holding on some?
You can do it on pretty much any stock. I prefer stuff over $5 a share just because you get a better premium. This one here turned out to look pretty good on paper. So, I mean, that's actually not a bad payout, to be honest, for fuel cell. But you can do it for any stock. It just, all you need is 100 shares. HYMC is almost like a little too little to make a lot of money the same way, or it would be the most attractive thing. Because, so like I said, you kind of want to be just big enough to where there's actually a premium spread, so you can actually make it. And I shouldn't have picked HYMC as an example, because isn't that kind of considered a squeeze play?
Yeah, no. The numbers are obviously, we see the red box numbers being manipulated like crazy, and word is that Hycroft short interest is not calculated properly. But I don't think you're going to make enough money on Hycroft really if you're doing it.
Yeah.
I'm not sure about that one, if it's a squeeze play or not, man. But I'm in. I'm bullish on it. But I mean, fundamentally, I'm looking at the value there. So
I see we got Super Steven in chat. Welcome back, man. I haven't seen you for a minute. Miss your input on stuff. But so like HYMC would only cost you about what, 130 some bucks to get a contract, to actually pay for enough shares to sell a contract. And for you to make about 1 to 2% on it is like $1 to $2. And it's possible, but to sell those contracts, it is kind of tough. And then usually, like I said, I like to kind of close things out on a Friday to lock in my gains. And it's tougher whenever you sell the contract for $2 and then you close it for $1. So you only make $1. It does seem like meaningless gains, but that's still almost a percentage gain. And 1% is still better than there's some of these retirement accounts out there that are giving you 4 to 5% on a year, because that would compound, and you can still eventually get more of a position.
I use Hycroft as an example because you're not taking a huge risk selling, say, a covered call on it. Because a lot of people have accumulated so many shares. Say it does squeeze up to $10, and you lose 100 shares of your 5,000 you have, you're still going to make money. I was saying if you are going to jump into your first trade like that, Hycroft probably is a good one to limit the amount of risk you're going to have on a loss if your contract fails. So, like, if you've never bought, if you've practiced and you're still not sure, and you were going to sell or buy or do a put or a call, Hycroft has a lot less risk as far as losing premium if you're doing like one contract. So
now we're going to do Tesla next, because like it's a lot more conservative, but I expect Tesla to be around in 10 years. The stock's going to grow. So when you put your money in a Tesla and you're holding long, I expect Tesla to start going back up in price at some point. So as Tesla doubles in price, so does your portfolio, and you gain premium. So it's a win-win stock. Maybe not short term. It might have a little bit more dipping to go, but longer term, I think it's still a good play, and you could play it for basically a longer term hold. So we're going to take a look at what it's currently trading at, which is 648. Let me put a dollar sign in there. That's what it's currently trading at. And then if you add 10% to that for a strike price, So we just take 648 times 1.1, and that gives you a 712. We're just going to round it down to 710. So we're going to do 710 strike, 1 week out. We're going to go in there and check out and see what the price is on it. Yeah, just double checking. I should probably figure out how many shares of stock we're going to end up getting. So let me put that in here. We're going to do 100,000, which will get you 154 shares. So you're kind of halfway in between a contract. So you won't make as much as you wanted, because you only have one contract and a half of one, and halves don't count.
Are you selling a covered call on Tesla?
Yeah.
Okay. I'll be the devil's advocate after you get done typing this call out.
All right. So we're doing 710 strike, which is about 10% markup.
So how many contracts can you buy?
As many as you can afford on whatever the stock price is.
Okay, because you just said you have 1.5. So you didn't want to make that 2 contracts?
Well, you can't. Tesla's so expensive. This is the problem with these expensive stocks. You can only afford to buy basically 1.5 contracts, but that half contract can't be used for anything because it's not complete. So you're kind of just stuck sitting on the shares. Let me see, 10%.
Yeah, remember that every one contract is 100 shares.
Got you. Hello, Miss Brenda Queen of Swords. She said you finally got her in. You figured it out, Froggy.
Yeah, well, the weird thing is after it was brought to my attention that she was blocked, it didn't show up on my YouTube for a pretty decent while longer before it popped up on there, so I'm not sure if they got like a delay. I didn't know what was wrong because I know I looked in everything, and then all of a sudden I went back and I'm like, well, I'll be. Here it is. You know, like there must have been a delay on showing who was blocked. Not sure exactly how somebody blocked it, but I ended up fixing it. The covered call price that you get would be $515, so you get one contract times $515. Obviously, it's going to be $515, but I'm putting this on here for a visual, and that gives you $515, 1 week, which isn't too bad of money, but you got to keep in mind you got a lot of wasted money sitting there, which you could be doing that with another place. You take them 54 shares, buy something else, get another a set of contracts, make money on both of them, and then when you can afford to get your second contract, you can just put it over here and drop it in there.
Hello, Z-Man. One moment, friends. Hello, Z-Man. They're not telling anyone to buy anything. You see, this is an opinion. They're just teaching. They're not telling anyone to buy anything, Z-Man. Thank you.
This is not unusual, Wales. So I'll play devil's advocate. Say within, you've got that's your contract you're going to sell, right, Froggy?
Yeah.
Your covered call. So by Wednesday, Elon Musk comes out and tweets that Starlink IPO is going to SPAC instead of going and an IPO. He's going to SPAC it, and it's going to be launched that week. What would the impacts of that be if then he rumored, oh, by the way, when it's done, we're merging Tesla? This is out there. But he's going to merge Tesla and Starlink together, and all of a sudden the Tesla price goes up to $900.
Well, so if the stock price jumped up to over 710 and went to like 740, the person that owns the contract has to pay me 10% markup, which would be 710 for a share that I paid 648. So I make 10%. and then they get to keep the $30 extra, which is, I call it selling future profits. I'm basically giving up anything over 710, which is profits I never received. And if we do get to 710, they pay me to basically sell them at that price. So
you still make your money.
I still make my money. You still get the premium. You get the markup on the strike. And they get to keep the $30 extra per share that you never knew was coming.
And that's if they exercise it. If they actually have the money to exercise. Some people go out and buy call options and they get way too many and they don't realize that they got to have that cash to exercise it properly.
Yep.
So that's something to look at too.
Okay. Mr. Tendie Time has a question.
Yes, no, that right. That's all we're trying to say earlier. How Froggy's talking about what he would do, not telling anyone to do. You're going to make money if you do it the right way. No, you're going to make money, period, because you will get the premium. The worst case scenario is you won't make as much money if the play runs, but if you had it set at 10%, you're still going to make your 10% in 1 week, and you're on to the next play, and you learn mistakes or whatever you want to call it, and you're going to make money. It's really a foolproof way, kind of, to a degree.
Well, that's why you don't want to do the squeeze play. And that's, I think, the best thing that Froggy mentioned at the top of his chart was no squeeze plays. Again, if you sell a covered call and the stock price squeezes out during the length of your contract, someone's going to exercise your shares. You'll still make money for your shares and your premium, but you could miss out on a 500% gain on those shares if, say, AMC runs really hard. That's why companies that are a little more stable and not in the meme stock scenario are better options to try to do this covered call thing on.
Now, if you look at
what does this mean when somebody say expired worthless? What does that mean? Because somebody said in the chat, expired, after you spoke the first time, Spence, someone said, or expired worthless. What is that?
Okay.
That's when you're buying contracts, though, not selling them.
Yeah,
go ahead, bro.
When you sell the contract, the person that bought it, their option expires worthless. You're actually playing the opposite side of the option. So where they're hoping that they gain value, they lose everything, so it expires worthless. And you gain everything, so you basically pocket 100% of the premium. So it's just a term that people use, or a saying that people use for options. And for some reason, people YOLO options really bad. They throw money knowing things aren't going to get there, and they just kind of hope for the best. And that's where money is made, and the market maker takes advantage of that. And I'm pretty
deep out of the money.
Yeah, I'm pretty
people
sure.
People love to do deep out of the money because the contracts are cheap, and then they lose out because it never gets anywhere near it.
Let me read what this guy named Jason said, see if it makes sense. He said, I've noticed if I buy a call on Monday, goes into or closer into the money by Wednesday, I can sell the contract back for the same profit as execution. What does he mean?
He's talking about buying the contract. It's a totally different thing.
It.
But he's kind of right. You don't actually have to exercise it. It's kind of close. So if you bought the contract and it gained money, you don't have to exercise it to make the profit. You can just sell it back to somebody else, and they'll exercise it because they got the money.
And never need the money to buy the shares. Now, you won't need the money to buy the shares, but it's always to be safe. You want to have the money in there, just in case it does go where it needs to go, and you want to exercise it and get them shares,
Yeah.
I will never play any kind of option unless I know I got the money in there to cover anything. That would be a big mistake.
Okay, this one guy said, this is what he says. I'm going to read you. Air G. He said, like me, I bought 500 IMPP shares at 48 cents. Once it went to 50 cents, it was above my average. So therefore, I sold 5 covered dollar calls end of the day, I don't lose because they'll buy it for $1 each a share. They'll buy it each for $1 a share. Does that sound right?
If you could sell it. If you could sell the contract, yeah.
Yeah, they get tougher to sell.
Does it sound right? Does that sound right?
Yeah. He made money off of his shares. The price went up. So now I think what I heard was he said he sold a covered call on that with a $1 strike price.
No, he said he sold, where'd he go? It says,
48 cents. He bought it and he sold it at 50.
Ah, yeah. Okay.
And he made $1 off of what? 2 of them, he said?
Right now, covered calls for IMPP is selling for roughly about $6 a contract. So you can and they're going to round it down, so I'd only expect to get $5. But you figure it's only going to cost you $56 to buy all them shares, and you can make up to $5. And that's actually pretty good money. But it's a July 15th contract, which is a pretty decent ways away. So you figure it's a multiplier. You're probably making $1.50 a week. And that's still not bad because you're still getting roughly 3 shares a week.
And like it's the exact opposite of buying and selling options. Like if you're buying calls, you know, it's safer to buy further out calls. It's the exact opposite if you're selling the calls.
Right.
It's safer to buy weekly calls or buy shorter time period calls. It's like it's so many ways you can make money in this market.
Just gotta make sure it don't get eaten up.
Yeah. So
I would say right now, learning about this is absolutely key for your investment strategy going forward. Right now, we're in a really precarious market situation where people are looking at another 30% downside or more, and the economy still isn't doing what they say it is. So you got to really take a step back before you go buy or sell any of these options. You got to look at how the company you're attempting to play an option on is trending or not trending with the market. And then you need to understand the company structure and what they're doing going forward. Because right now, AMC's got a lot of stuff and GameStop's got a lot of stuff going for it in the future, right? So if you sell a covered call on GameStop out to $600-700 because you think, okay, well, they're still processing, they're still doing this and that, I'm going to make some premium, all good. But then all of a sudden next week, Ryan Cohen announces the GameStop dividend stock split numbers. You could get immediately pushed right out of your shares you own. You would make your premium and you would still get money for your shares, but you could miss out on a 40% gain. So you got to understand the company that you're playing the option in, and you need to understand the current market situation too.
Yeah,
I see the one is up here in the space call, but one's in the space call. Oh, it's just that.
Welcome to one. Yeah, so that's why we said that squeeze stocks are definitely not a good idea to do, because they squeeze while you're selling covered calls. You miss the top end. And again, long plays that have the tax bonus for being 1 year plus are actually bad ideas, because if they do get sold at a marked up price, you go into a different tax bracket. So it's easier for someone that, we'll say, has like $71,000 and wants to buy a stock. You pick something that's reasonable, that looks like it's going to hold steady. You buy into it, and then you turn around and you sell covered calls. If the stock goes up, you make money. If it doesn't go up, you make money. And even when it goes up, you make money possibly twice, and it becomes a win-win. A lot of people don't even know about this technique, and I think it's really good for people that do have portfolios over like 100,000, because you can invest in, I don't want to say Tesla, for instance, because it's a bad example at 100,000, just because of the fact that 54 shares are being unused for the premium. But if you like Tesla, which I do, I wouldn't mind the 54 shares being sitting there, but I would probably roll them over into something else. Like, for instance, I'll take 54 shares, times that by 648, divide that by SPY. What is that? 366, I'll say. It's almost 100 shares. You could do it in SPY. And SPY has contracts that aren't weekly. They're like 3 days. So you can go over there and do it. We should do a SPY one real quick just to get an idea of what it is, because it's a lot faster. I don't want to say it's easier money. It's, 5 days of waiting for your contract to play out can be stressful if you got an active stock market. And SPY's contracts, they get burned up so quick that it's easier premium. But I don't want to say easier and push people to it. So we're going to do SPY next as an example.
Let's do I'm going to buy a SPY contract and you're going to type it up. So I'm looking at the SPY because I'm looking at the chart right now, and I know it has not hit back down to the pre-pandemic high, which was 330. So me personally, I'm like, okay, looks like there's some downside to the SPY. And I know that we're getting another 75 BPS interest rate raised by the Fed next month, right? So now I have some market conditions that I think the SPY is going to go to the downside. So I'm interested in an option.
What I came back with $100,000 is 272 shares, which is going to be 2 contracts. So now what strike were you looking at?
Let's say are we doing this? How long? What's the time frame on the contract?
June 22nd is going to be the nearest one, which is only 2 days away. So we got Tuesday, Wednesday, and then you get then that contract dies.
Let's do next week.
Oh, you want to go a week further out?
Yeah.
Let's see what we got. We got 24, which is Friday, 27, which is Monday. We could do 29th. So we're going to do 1, 2, 3, 4, 5, 6, 7 days. So I'll just call it June 29th. And then what strike do you want?
And what are we doing here? Are we selling something, or are we buying?
Selling covered call.
Selling a covered call? Okay. I got to turn my thesis around that. We're selling a covered call. The market looks like it's going down. So chances are we're not going to get exercised. So I'll sell a covered call higher up into, I guess it depends too. I'm not looking at the chart, but where are we sitting now? We're at 365. So what do you think? Like a 375, 380?
Yeah, 375 would be pretty good.
Yeah. Because we know there's downside in the market. So we're putting our strike price out far enough where we're hoping not to get exercised.
Yeah, we could be conservative and just go 380 because you just want to play it safe.
Yeah.
And I think that's still, I think it's like 5% markup. So we got 380 strike with a delta of 22%.
So a pretty low chance of us getting exercised.
Yeah. And this is why you look at your delta, so people can use that as an idea of the odds of getting burnt. So you got 2 contracts, and your premium will end up being $220. So that puts you at pretty much $440, and that's next week Wednesday is when you get paid that, which is not bad money at all. Figuring that's probably still better than what people would make off of a retirement account. With
well, consider this: you take your 440 and you jump in and buy another share, and then you sell it next week. And this strategy is real great for the entire downside of the SPY. If you started doing this around 450, right? You were making money on the downside, even though your shares are decreasing in value. You're making money on the downside of SPY the entire time, buying more shares through the dip with the premium you're making until we hit a bottom. And then you're like, okay, wow, we just crashed hard. We hit 330. It looks like the SPY is probably done going down. Economic turnarounds coming. Now what's a better strategy now that we see the SPY's bottomed out and we're starting to come back up?
I'm adding in a 370 strike just to see what the numbers look like. So your delta is 31%.
But you'll be more profitable on your on your gains.
So you're looking at a payout of $351, which is,
what is that? Every 2 days or 3 days?
Oh, I didn't mean to put that in there. That's going to be for a week and 2 days.
Okay.
Next Wednesday.
Risk reward. That's still pretty low risk for a higher payout, 31%.
Yeah. Yeah. And the thing is, you want to stay down like closer to 30 or lower to make sure it's a safe thing to do. But again, each stock is different. I know SPY has high liquidity. There's money like everywhere. So it's actually not a bad pick. There's other plays that you can do that has a 31% delta that probably pay double that, but you just got to find them. They get high options being bought, high IV, high volatility, and they can pay more, but you got to find those. They're out there. It's usually something in the news.
And the best part about this situation right now is you guys have seen the hedge funds falling left and right. There's probably more liquidations coming. I mean, we just heard about Tiger Praetorian, I think it was, last week. So when you're doing this, again, understanding the overall market, seeing the hedge funds that are doing bad, seeing the overall economy, that's what's going to help you make your decision what type of option you're going to play. Don't just jump in because somebody got on Twitter and typed jumping into calls on a stock, because you could get absolutely crushed. That's why that's kind of why I got into it with some other YouTubers this last couple months.
I'm going to do DWAC this time. You could do puts or calls on this one. I'm just going to do calls just because it's like kind of a standard kind of thing to look at. So we're looking at a price of, because I don't think it's a squeeze play since it hasn't merged.
Which hedge fund was that, Spence?
I thought it was Tiger Praetorian. It wasn't Tiger Cubs or Tiger Global. It was Tiger. I thought it was Praetorian. Let's see. I'll look it up. I got it in my DM somewhere.
Okay. Is it Tiger Global?
No, not Global. Global's coming up. They're in line, but it wasn't Global.
Okay.
So we got 1 week covered call sold. And we're looking for a strike. So we're just going to go up 10% just to play it safe. Puts you at about 30. So we're going to do a 30 strike. And that will pay roughly $1.22. So we're going to get the delta in here real quick. Delta is actually 37.15. So that's going to be very interesting because it's probably going to have higher pay. even though you're 10% further out with a 30 strike, you're still looking at 37.1%.
It was Tiger like
Yeah,
Tiger.
Legatus, right?
Yeah, Legatus. Yeah,
I just figured.
I knew it was some Roman stuff.
Yeah, dang. It says they're shutting down. Wow.
But that's what you got to keep an eye out for, is these hedge funds shutting down, because when they get liquidated, it affects the markets drastically.
Well, here's a good example of that can't be right. Is that right? Well, here you go. Here's an example of high risk, high reward. So DWAC priced at $27.85. That's up with $100,000. You can get 3,590 shares, almost 36 contracts, but not quite. 1 week covered call sold at a 30 strike gives you the delta of you have a 37% chance of it going into money. I would probably play a little further out just to play it safe. Because 37 is actually kind of high. You want to be closer to 30 or lower, but this is still 10% out. Let me see if I put that in here. 10% markup. And it came back at $4,270. That's actually not bad, but right now with the way DWAC is going down, you could probably lose that in stock value. If it drops $1, you'd lose 3,590. So it's one of them ones. It's a pretty volatile stock for the price movement, but the payout is really nice. Let me see.
Keep in mind, DWAC is still being investigated. I don't know if it's legitimate or not, but Congress is investigating DWAC, of course, because it's Trump. So again, you have another market situation, and where you have to understand that if Congress before midterms comes out and decides to go, yeah, DWAC's completely corrupt, we're going to shut it down, blah, 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 that SPAC deal might get put on hold or halted. So that's something to think about too.
Now I found at 31 strike, it gives you about a 30% delta, and your payout changes, of course, but you still get $91, which is pretty decent, and it still gives you a pretty respectable pay of $3,100.
$3,100.
So that's not bad at all. I mean, but you got to keep in mind, it's not really a full company yet. It hasn't merged, and it hasn't done all the stuff it has to. So right now it's kind of a shaky thing. Until they start actually doing something and having fundamentals, I personally would stay away from it because it is high risk. But you usually want to invest in longer term plays. This would be a risky play to even be in unless you kind of have confidence that the merger is going to go through. Trump's going to be allowed to come to market with it and all that stuff. But that right there is pretty good money. You could even put puts on it. Yeah. You can place puts on it, so which means you put zero money into the stock and you can just extract wealth right out of it.
Hey, Brenda said AMC July 8th, $25 calls, $13 each at 28 cents at Super Steve. What? Explain what
this is what she said. She said, Froggy, I'm not knowing options, but I bought July 8th, 2.5 calls, 13 each, .10 each. What have I done? And what will I gain, please? That's the first part of it. Then the second part is what H was saying.
Okay,
I'll
read
check the first part again.
Okay, here you go. She said, I brought calls. Oh, no, that was the second.
Yeah, she was talking to Steve.
She said, I'm not knowing options, but I brought July 8th, 2.5 calls, 13 each, 10 each. What have I done? And what will I gain, please?
So did she buy deep in the money? 2.5 or 25?
She took 2.5 calls.
I'll get there here in a second. So I'm doing a put. We haven't got to show a put yet. So I took the DWAC, and it works up to be 25 and 6 pennies, which is pretty safe to say a 25 strike with puts without investing any money into the stock. You got a 10% markdown. We're going to check the delta. I'll come back and get you here in a second, Brenda. So let's go and check and see what that is so you can see the other side of the equation. So that is a 26.9% delta, which is actually pretty reasonable. And then that's 35 contracts with a payout of 127. So this is the reason why I wanted to do a put. So you basically risk, I don't want to say nothing, but you have no money invested in the company, and you're still getting an outrageously high return. And that gives you $4,445 for 1 week off of 100 grand. And if you want to be less risky, you can go further down. You can hit 24 puts. Delta would be 21.8. And that would leave you 35 times $1 or $100, which is still $3,500. And that's still pretty good because the chances of WAC going to 24, I wouldn't really expect it. $3,500 weekly off of 100 grand without having any money, like any basically skin in the game, I think is a really good deal. Because that's why I always say you don't want to hold the asset when it's going down in price. I think DWAC might go down lower. You still get your premium. You don't put your money at risk. Now, if it goes and falls down underneath 24, I think that does come out from you. So I can't remember exactly how the puts go because I don't usually play covered puts. But I'll have to look back into that one and try to figure it out. Let's do Brenda's. Brenda was talking about AMC.
Yeah, she was talking. She said something. The first one, she said, "Okay, I bought calls."
BBIG was the first one. That's the first one she was saying.
Right.
Now, typically we don't do squeeze plays, but we'll get the numbers just so you can see it. So you're looking at a July 8th.
July 8th, yeah.
And that's a 25 strike.
Yeah, that was just confusing to me, though. Because she said 28 cents. $25 calls, 13 each.
I got to go pull up all the information so we got visuals. So we're going to do 1235. And we're just going to figure it off 100,000. I know you don't have that much in there. But this will give you an idea. You can always factor the ratio off of it.
July 8th, $2.50 calls, 13 of them. And then she said 10 each. What have I done? And what will I gain?
So that's 8,097 shares, which is 80.9 contracts, but 0.9 don't count. So you got 80 contracts. And then we'll come down here. We're going to go figure out the delta for that one. So that's only 3 weeks out for anybody that doesn't know. So I'm going to type it here, 3 weeks. And oh wow, you got your strike way out there.
Mm.
And you sold covered put or calls. You're pretty safe, I would think, at 25. Your delta right now, which is your risk, is only 7.8%. So I wouldn't figure your chances of getting wiped out are possible. But if it jumped 25 per share, you're only going to make 25 per share. But you've already collected premium, which that would be, let me see, 80 contracts times, it's only $14. And that gives you, that's actually pretty decent money still, which is crazy.
Which ones? The ones Brenda's talking about?
Well, if you had 100,000 invested doing it like ultra safe, I mean, you're looking at $1,120.
Right.
Well, never mind. It's 3 weeks. So you divide that by 3, and you would get 373 per week.
Does anybody understand what Brenda was saying though?
I do.
Okay. All right, because when she threw all those numbers in there and then said each, I was confused.
No, I understand options and premium and stuff. The only thing I've so far,
it's just the way that she explained it. That's what confused me.
The only thing that tripped me up so far is what happens when you sell a covered put and it goes below your strike. Like, where does that money come from?
Okay.
So on this contract you just typed up, Froggy, let's play the good side and the bad side.
Yep.
So you sold that covered call right now, and you have a 7.8% chance, which is really low, of that hitting the strike price. So you're pretty safe. Elon Musk just come out and said, "Oh, by the way, I'm buying 500, or I'm buying 6 million shares of AMC tomorrow." So now all of a sudden FOMO kicks in, your strike price goes up, or the AMC price goes up, and we go to $40.
Yeah.
So you're still going to get paid for your shares. You're still going to get your premium, but you're going to miss out on whatever it is above the 25 strike.
Yep.
Now, if it doesn't, she's going to make $373 a week, keep her shares, and reinvest that.
Yep. She'll lose 15 a share, or she won't gain the profits of 15 a share, but she'll get paid $25 per share that she sold.
Right.
So you're capped at 25.
It was Brenda, right? So that's
yep.
that's the outcomes you're looking at, Brenda. If something crazy happens and the stock price explodes, somebody could exercise the option they bought from you. They're going to pay you for your shares. You're going to get your premium, but those shares are going to be gone out of your account. If they don't, you're going to make your premium and you're going to keep your shares.
Now, if they execute them at 25, you have a chance to buy back in and ride the rest of the way back up. Now, if they wait until it's 30 and they execute them, which is probably more likely going to happen, you could buy back in at 30, get less shares, but you can still ride up to 40. And that's how it is. Whenever your shares get converted or bought from you, you have the choice of going back in and chasing or just waiting for it to come back down. It depends on the news. If Elon was buying, I'd expect it to go up and probably stay there. There will be a FOMO rip, just like there always is. It goes way up past a certain point, comes back. But that's just kind of the game of the market. But making 373 per week on a strike that far away is not bad at all.
Wow.
So, I mean...
Okay, Ancor said, I'm sorry, Ancor said, what is the ideal bracket percentage on the delta for the puts and calls, though?
Where did you see that question?
Ancor, he's right under Brenda.
Oh, ideal bracket. Each stock is different. If you got a slower stock like ExxonMobil, you can be safe with a markup price of 5%. But if you got something more reactive like Tesla, you want to be more like 10% away from current price. So each stock is different based upon its own volatility. And typically you want to know the stock that you're investing in So you can have an idea of how much it has for like a mood swing. So then you can just basically put the carrot just outside the mood swing, and you can always make money. It's kind of like being like Floyd Mayweather. You stick your head in and you bait them to try to hit it, and then as soon as they try to do, they take a swing, you just lean back and like, ha, you missed. You missed again. And when you do that, you just pocket all the money. And that's the name of the game. That's probably a bad example. I'm a dude. That's how we relate to things. Anybody else have any other stocks that they have an idea that they would want?
She also said something about BBIG.
BBIG, yeah. BBIG, she did that one too. And Super Steven asked her why would she chose that one, and what was her thesis behind that. And she said the price, she's betting the price will go, what she say? The price goes up. That's what she's betting on.
Okay.
But she said on that one, she brought BBIG the same thing, the same way.
Now, from what I understand, BBIG is a squeeze play, so we wouldn't typically do it, but we're going to cover it just because you want to see the numbers, and that's what we're going to do here. So again, we're going to go back to the 100,000 standard stock price is, and that's just so you can get a ratio of what things pay out. Currently, Venco Ventures is trading at $2.18. You're going to use your standard of 100,000. And we're going to go figure out how many shares you're going to get for that, which is a lot. That gives you 45,871 shares, which, I mean, that tells you there's going to be a lot of contracts, but it's a cheap price, so it's going to be a lot of small contracts. So now what we're going to do is we're going to take that price and do a markup of 10% just because it's a standard. So we take the 218 times that by 1.1, and that gives you 2.39, so $2.39. We're going to go over and check out the option chain for next week. So we're going to do let me see.
Did you use she said, why are you using 100,000 shares?
No, $100,000. That's just so you can get an idea of what 100,000 does, because I don't know how much each person's spending. So if you got $10,000, you just take it 1/10 of all the numbers. If you got $20,000 invested, you just take 1/5. It's just it's like a standard that I'm using, so you can see how much the payout is for 100,000. So we're going to take the strike price of $2.50, one-week contract, and then we're going to
do. She's saying, can you do it with $100 though? Can you give her an example with the 100?
No, because $100 won't get you 100 shares, and if you're going to do one contract. You just take that first number off the formula over here where it says like 80 times whatever. You just take that number off, and this is your premium number. And I'll show you that here in a second. So we're looking at 26% delta. And then your premium, it's saying $7, but like I said, I'm pretty sure they're going to knock it down to like $5. But we're going to use the 7 just because it's there. 450 contracts times $7. Now, if you only have one contract, you just times it by that 7 and you get your answer. You'll make $7 for 100 shares. So what we're looking at is 458 times 7, and it gives you $3,206 for a week. This number right here is your premium number per contract. This is your multiplier, and this is being based off of 1 week. because I was doing a formula where if you could buy a Tesla for like $75,000, if you turned it around and you just sold premium instead of paying for a Cybertruck in cash, you can actually make enough in premium to go and pay the car or pay for the Cybertruck and never actually touch your initial investment. So then after you pay it off after so long, you still have all the money still sitting there and some, and then you just buy another one if you wanted to, or pay for a house. So there's different options that you can have.
Eric G said, cover calls, you have to have capital for cover calls?
No, covered puts, you have to have the cash to cover the amount of shares that could be there. Right. Brenda says he needs to do a normal people money examples. It's a good number to go with ratios. I could do 10,000. You just take one number off the end of it.
Yeah.
Let's say, can you do like 70? Let's say 70,000. That's a good number. Can you do something like with 70,000?
We'll go down to 10. Just because that gets you a little bit closer. You can see here there's $10,000. And we move the numbers around here. So you're still getting $320 a week off of 10 grand, which is still pretty good. So it proves you don't need that much money to actually make a pretty decent amount of extra money, if that helps, Brenda.
She said he needs to do normal people money. Brenda, you a trip.
Well, I was basing it because like some people are told you got to have $1 million to retire, and this is proven you can retire off of 100,000. So once you make it to that
now, right?
I think 100,000 is a really easy to achieve number for people that. I mean, I'm not saying you want to retire as soon as you get 100,000, but you can produce a secondary income, and it could pay for basically your house payment. So then this whole idea of like you can't afford to go get your own house. Well, if you have 100,000 saved up, you can either pay for a house or you can just make the premium payments pay for your house, and it's. As long as the stock is growing in price, you can actually get more and more premium year after year. So if you're invested in like a Tesla, when you have that money and the Tesla stock keeps growing in price, you grow in premium. So if the stock doubles in price, your premium probably doubles as well, and your initial investment. So if you had 100,000 invested, it would go to 200,000, and your premium payments would be like $1,500 a week, instead of like $750 a week. So that's what I'm looking at. Was $100,000 is pretty much all you need to change your life. And you get to manage it yourself. Instead of giving it to somebody else that's going to go and give you 20%, and then they're going to go make the difference and put it in their pocket.
But you're using your $100,000 though.
I was using 100,000, yeah.
No, I'm saying, but you're using your $100,000. If a person, and your example, they retired off the 100,000, they really ain't, because you're making them use that 100,000 to make money.
Well, right, but it's reoccurring it's reoccurring for basically the rest of your life if you wanted to use it that way.
What's up, Kat?
Brenda says, why can't you just do AMC? Someone buys 13 contracts of AMC. They paid 28 cents for each 13 contracts.
Just do 13 contracts. That's what she wants you to do. Instead of the 250 or the 4,000 shares, just do the 13 she grabbed.
Yeah, I can put that up here. I mean, we'll just...
But I thought you said you can't use something that's a squeeze play. So why would you use AMC?
Well, you don't want to use something that's a squeeze play, but you definitely can. But I wouldn't recommend it for selling covered calls. And obviously, you've shown in the past couple months that buying calls on AMC tends to pay market makers premium quite often. So.
He ain't lying. Trust me. I learned the hard way. I kept giving him my money in the beginning.
Options are addicting, and a lot of people love doing them.
Learn them.
But when you know you can actually make that money and reduce your risk at the same time, it's like a lot of people want to learn options. But if you knew that you could just take what you have and do safer investing, and you don't have to worry about learning how to day trade, you don't have to worry about the risk, because like this setup here is actually a lower risk than doing options is dangerous.
Right.
And you want to learn.
I was happy.
You got to learn charting, day trading. Then you got to learn the mechanics of options in order to make that money. This here, you just go in and you just figure if you know your stock and you just think off the top of your head, I've been following Tesla for a year. I don't think it's going to go up much more than $60 this week. Okay, set that as your strike price. Sell that contract. If it goes up and grazes that number and they don't execute it, it comes back down. You eat all the premium, and that's what it is. It's if it does graze it and they go and buy you out, then you basically sold those shares anyways.
Right.
And you locked in a higher return. So I can't say it's a win-win, but it's almost a win-win.
I've got a little breaking news comment from somebody in my DMs. They said that Trey just made a video about DRS. A little off topic, but figured you might want to check that out.
It's interesting. He's only, 2 weeks behind us?
I figured. I actually DM'd him and I asked him what he thought about it. And we talked about it in our space call the other day. So I'm assuming he was in there under maybe one of his buddies, or he was in there under another account. But it'd be interesting to see what he says about it.
I still want to dig into the DRS thing, because now that's where I get confused. Can you DRS and sell covered calls? I don't think.
I don't think you can sell options on computer share.
Yeah, because it's like a as basic as you can get.
You know what? That's pretty cool, though. You can just go ahead and get your options and keep them in that account and just don't worry about them and play on the other apps. You know what I mean?
Yeah. Put your long positions away in the safe haven, and then you play your other stuff in Fidelity.
Yep.
So, because you know Fidelity's not going to go bankrupt. If you're on Robinhood and you're doing all this swinging around and then Robinhood turns up, belly up, then you got to cash in your SIPC and get your money back that way. And like I said, I keep counting on Robinhood to go toast, but
you think that thing is ever going to go back up to normal?
No. Vlad's pretty well hated.
Was that even normal? Was it too high anyway for the company?
Maybe that's what Adam Aaron's going to buy. That $100 million, he's going to buy Robinhood.
Maybe.
If it comes down low enough.
The paperwork alone, the files are worth more than $100 million at Robinhood, man.
Wasn't that like $7?
It's getting down there. I thought it hit 5 at one point.
Wow.
Let me go check real quick. Oh man!
Right now,
it's looking pretty gross.
19, yeah.
719. Yep.
That thing was way up there too.
Market cap is 6.2, which is pretty impressive. But
6.2 bill.
Yeah, it'll come down further. Somebody's going to buy that as soon as it hits like $1 billion, because they got so many people that are still on it. But don't they have debt?
I know their earnings aren't good.
Oh, their earnings are horrible.
Yep, they've been for a long time, too.
So, Brenda, I got your numbers right up here for AMC. 13 contracts, 3 weeks. And you're saying you sold them at 28, so you're looking at $384 of what you should have been paid. So, I mean, let's see if I can figure out what your initial investment is.
If it was to go to what, though? That's the question.
Right now,
what was our break even? Do we know that?
Hold on.
Yeah, let me see.
So your portfolio right now would be worth about $16,055 for 13 contracts, and you're going to make $384. That's actually not too bad, even though it's 3 weeks.
She said the 8th, right?
That's still not too bad, just because of the fact that, if you had more money, you can make more money. But I mean, $384 is basically a passive income. And the odds of hitting that, 25 strike?
Yeah, she said 25.
But if it's squeezed, does she lose it? Does she lose the, let's say if she's doing whatever she's doing, whatever option track I'm talking about, and the squeeze is run the same time she does that. Does she lose her
premium
option part, or she lose her AMC part, or she doesn't lose anything? That's what I'm asking.
If it goes up over 25, we'll say it shoots up from here to like 100. She'll only get paid 25 per share and get bought out.
Oh my Lord!
The $75. That's why I said don't do squeeze stocks, because when it squeezes or starts running up, she would miss out on the opportunity of $75 a share, and she would only get paid 25 per share.
Right.
So I had a friend who sold a covered call on AMC last year, right?
Mm-hmm.
Guess what happened? Stock ran at $72, and he missed out on everything past the strike price.
Because he didn't have the cash in there, right?
Dude, he was like, no, he sold a covered call, right? And he put like $25, $30. Well, then it ran from 15 to 72 in a period of 6 days or whatever.
Right.
Yeah. So everything past the strike, he got his shares paid for at whatever the strike price was, but everything past that up to 72, he missed out on. So he was like, oh man, that's why squeeze plays are horrible to do this on.
What?
Because you run the risk of missing out on a major gain because the call went in the money, way out in the money, really quick.
Wow.
Yeah, you got to be careful with them squeeze plays, because if you do...
That's for the covered, though, right?
Yeah, anytime you sell a call, you basically sell the top of your contract. Like anything over that strike, you don't get a penny of it.
Right, but I don't think she's talking about a covered call.
Yeah, he sold a covered call.
Yeah, she's talking about just like a regular call or a regular put. No,
he sold a covered call and it squeezed up to 72. If you bought a call like Trey did on AMC back at that time and it ran to 72, he made mega buku bucks. Yeah. But if you sold a covered call and it went past the strike you agreed on, you're going to get that strike plus the premium. But everything, say, past $25 up to 77, you're now missing out on those shares because they're going to exercise your shares and take them.
Yeah, and to me, this is actually like really easy money for anybody that has, because you shouldn't have all your eggs wrapped up in AMC or GME. You should probably have multiple plays. I'm not saying sell AMC and go back to like splitting it between Tesla, Ford, whatever.
Right.
I'm just saying. Most people, or some people, have a chunk of AMC, a chunk of something else, and a chunk of something else, like NEO, Tesla, AMC, GME. Mm-hmm. And those other plays are sitting there. You could go and sell premium and buy more AMC and rinse and repeat and just keep accumulating off the other positions. And there is other options too. And I don't want to get too much into detail. Like, say, if you wanted to sell your NEO position, buy AMC, but like you sell $50,000 in NEO, buy AMC, and then you sell the covered calls on only that $50,000. You weren't going to get the squeeze with that NEO money anyways. Right. But we're talking now. You're getting complex, but you can still make the money over in NEO and transfer it over into AMC and contribute to the play with raw shares. And it also keeps people from getting into the options in AMC, because you see all them people buying options, like tons of calls, and they're getting blown out.
Right.
You're selling to those people, and they're getting blown out. So instead of the market maker getting that money, you are. So eventually...
I get it, Miss Brenda. We were just trying to figure out if you was actually doing covered calls or you was just doing like a regular premium call. And that's what I think she was doing.
Oh, she wants to know what she's going to do with it. You basically have to ride it out till the end of the contract, the agreement. You have a 3-week agreement.
Right.
And as long as it doesn't go over 25, that money that you were given the day that you sold them covered calls, it's dropped in your account. You can do whatever you want with it.
Right.
But I would just buy more AMC shares or just sit on the cash and just wait for the contracts to complete. It's up to you either which way. If you think AMC is going to maintain value, buy in. If you think it's going to go lower, don't buy in. If you think it's going to go up, just you make sure you buy in. So
you said $25 strike, right?
Yeah, she's pretty safe out there, I would think.
So she said she paid how much? $13 each for each one?
No. She had 13 contracts.
Right, but she said July 8th, right?
3 weeks out. Yep.
Right, for her regular calls.
I think she said she sold covered calls.
Oh, see, I didn't think she was talking about covered. I thought she was talking about regular calls. That means she would have to have how many shares in her account?
1,300 shares.
1,300. Okay.
Which is a
point. Wait a minute. So you guys think she's betting against her? Wait.
That's what she's doing right now. If she's not playing regular calls, she's betting against what she has in her pocket.
Versus Wall Street. So when she's doing these calls, she's using her AMC shares?
Correct.
Oh no.
If it goes horribly wrong. Now, if it goes well for her, you know.
Yeah, as long as it doesn't squeeze, she's fine from here to there. But that's one of the rules. Just don't play the squeeze plays in that type of way, just because you don't want to miss out on the moon. But I mean,
see, that's why I don't do them. I just play regular calls, man. I ain't going to.
This is the stuff.
I'm not risking them.
This is the exact stuff I wanted to cover after the squeeze, so you can make a massive passive income. And your only job would just be to go sell covered calls and kick back and just manage your money. Right. And if that's all you had to do is spend maybe, I don't know, a couple hours a week, and you could make a fortune off it. I mean, I think that's very beneficial for everybody, and it doesn't really hurt.
She bought regular calls. Regular call. She said, at Miss Harris, no, covered calls. No, I bought a regular call.
Oh, she bought regular calls.
13 regular calls.
What's the difference between you bought a cover call? What's the difference between a cover call, regular call? What's the difference?
The covers, you need to have the amount of shares in your account for each contract you purchase.
A covered call means she sold a contract. If you bought a contract or a regular call, then she bought it from somebody else. If you bought a regular call contract at 25, your ratio of chances of actually getting that to go into money, 7.8% chance. You can gain on it, but your chances of that contract going into money is very slim. So, yeah,
and that's a 25, right?
Yeah.
If you get lucky in July, if she bought a call, she bought calls. She bought it at a $25 strike.
Correct.
If the price does not get to $25 break even or above, she's not going to make any money on it. And if it does go to like 40 or 50 and she exercises, she's going to need to have the money in her account to exercise those shares.
Right.
So here's the thing with this is July 8th's around the corner, and AMC is looking really good, and we're probably going to have good earnings reported out to August. But this is why we did the no options May thing back then, was because people were buying calls that were a week, 2 or 3 weeks out.
Right.
And what was happening is we were being price fixed below max paying every single time. So people were just losing their premiums. So if her call does not land in the money, she's just going to lose the money she spent on the premium.
Correct. Yeah. Or the theta's going to eat it all up.
That's dangerous.
But she still doesn't keep. So when she brought these calls, she actually brought somebody's AMC shares. Is that what that means?
No, when you buy calls, you buy leverage to. You basically have control of 1,300 shares.
Right.
but you pay a premium
for each one. It's 100.
So she probably paid $384 for 13 contracts.
Correct.
And now she's hoping it goes up. Now the delta also tells you how much you get paid. So you get paid for every dollar that it moves about almost 7.8%. So it's not very good pay at that point, just because of the way that the delta works. It's telling you how much you're going to gain per buck, or roughly that. So
question is, how much is it?
Since she bought a call, say Wednesday, AMC goes to $23.
Right.
Does she have the option to sell that contract back out that she bought?
Yeah, it'll go up in price. So if she paid $28 per contract, it may be worth 50 cents. So
Right.
she'll make, I don't know if that's actually what the ratio will be, but she said I paid $28 for the 13 calls. Yeah. Oh, well, that's not bad at all. So you must have got them when they were real cheap.
Yeah, real cheap. Because she said 28 cents. I believe that's what she said, 28 cents for each contract.
I thought it was 28 per contract. She's saying right there she paid 28 for the 13 calls.
Right. She must have bought them a long time ago then.
Yeah.
Until July 8th now. That's crazy.
I'm willing to bet you paid 28 per contract and not 28 for all 13. That would be stealing them at that price.
Yeah, I'm going to go look at them real quick.
I'm looking at the premium, and it is, I think it's like $14 or something. So
yeah,
it's going to continue to go down because that's what Theta does.
Right.
And when Theta ticks away per day, you lose a certain value. Yep. And it's like, let me go back and check and see what your Theta is. Theta on that one is basically 2 pennies per day, which is ideally a little over $2 is what you're going to burn per day that you don't make it to 25.
Might want to just ask when she bought those.
Yeah.
Well, judging by it being currently priced at 14, she paid 28. She probably bought it a week ago.
So she lost a couple dollars already.
Yeah.
Holding them.
Because you just reversed the Theta, ideally, and it puts you about a week ago.
Right. That means if it goes up from where she had bought it, she might be able to exercise them and get them for cheaper than what? I don't know. We'll see when she bought them.
You need to see some pretty good price movement by July.
Yeah.
Yep. It's possible. Who knows? I mean, we ran to $34 in one day.
True.
Lucky shot, but
options. You don't typically hold options for a period of time. You get in, you get out. That's pretty much it. Where Deep Value, where he bought them and held on to them for like 6 months, that was ludicrous. But he got lucky because there was a run up that happened in there, and it technically it's a very poor example of how to play options. But he lucked out because he bought like a decade out in the future. Yeah. And then basically people rallied around his play, bought in, it forced the price up, and he got lucky and made a killing. And so what he bought was basically a YOLO play that paid out.
So, Brenda, technically when you buy a regular call option and you buy it at that strike price, you're hoping that it goes way above that strike price so that you can make money. If you don't think it's going to go that high, then, I wouldn't touch it. But, that's what she said. She said, what's the use in buying option calls if I make no money? You make no money if it doesn't reach, where it's supposed to go.
See, that's what me and Froggy were talking about for the past month is a lot of influencers are coming out and tweeting, jumping into AMC calls, jumping into GME calls, right? And their followers follow them into that play because they think they're going to make money without really knowing what's going on.
Right.
Well, on the side, what's happening is all these people who are not understanding options fully are jumping into calls, and then suddenly the price doesn't go up, and now you're out of your premium. You don't own any shares and you're out of your premium. And more than likely, a market maker like Citadel or Virtue is taking their premium and using it as liquidity to play against everybody else that is holding AMC or GME shares. That's why I don't really like buying calls on MEEP stocks.
Now, I'll tell you something. I don't know if Casey Shaw is still here. Casey Shaw told me that if you sell covered calls, it's actually bullish. And at first I thought, there's no way. Because if I sell covered call, I'm expecting it to go down, just like what is being said here. You're betting against AMC moving up.
Right.
But when you think about it, he's actually right, because in order for you to make money on a covered call, you have to have your initial investment going up in price too, so you lose nothing. What's the benefit if you gain $400 on selling a covered call when your investment goes down $2,000?
Right.
You don't gain. You just lose less. So you want to be bullish on a stock if you're going to buy into the stock, so it's going to go up, and you're just dangling the carrot too far out to where it doesn't, so you can make the premium too. So you get the stock gain and the premium, and you get that win-win.
Right.
And if you're selling covered calls, if you own a bunch of shares of, say, like AMC, you're selling covered calls. Essentially, on the way down, if you know it's going, you're just hedging a little bit. You're just trying to reduce your loss.
Yeah, right. It is a hedge too. So we're Astro and Trey was kind of right. Was the fact that not buying puts, but selling covered puts would have probably been smart, but that means you had to sell, which is stupid. But I think selling covered calls would have, they had an idea, it's just kind of the opposite. Instead of buying puts, selling covered calls would have made you money. It would have hedged. And then once the play reversed, you would have still accumulated to your position. And I think that would have probably been a good idea. But I think that still comes down to experience. I think that's where they missed it, was I still don't understand why buying puts would have actually been a good idea.
Well, they were the right person pretty bearish on AMC, talking, $7 and $5, and a few of them not saying necessarily asking to trade $3. But when you tell people to start hedging after we've had a 70% drop in stock price, it's too late for that, because if you're hedging down at bottom, you're just reducing your gains on the way back up, which we're getting ready. Personally, it's looking like we're in a reversal already. So,
right.
Spence, where's the best time to go and sell your covered call? When a stock got done dipping or when it got done ripping?
Exactly. That's exactly it. Like, we're down to what we hit 990, and you're selling covered calls. You have more risk of the stock going to the upside now, and you losing your shares that you just took a 70% drop on from a high of 72. If anything, now is the time to sell. You would want to sell puts now, but again, in the same situation, you own shares, so it's a tricky thing.
You're stuck into, okay. So right now, if we're seeing the bottom of AMC, to sell a put, you have to be out of AMC, which is not what you want. So selling a covered call would actually be bullish. You're expecting your main portfolio to go back up. So
unless you got squeezed out, if you sell a covered call and get squeezed out in a 1 day period, you're going to be kicking yourself in the butt. But if you're sure in your investment and you think, okay, well, I'll set a high strike and I don't think it's going to go to the moon until that time, you're gaining on your shares and you're gaining on your premium. But you got to be really careful that something doesn't happen. Like Adam Aaron said, we're not going to pounce until after Q2, which I think is going to be profitable. So I would say if you were going to do it from now until earnings, you might be okay. But also keep in mind, one hedge fund gets margin called that's short in AMC, stock price goes through the roof.
Yep. That's why I still say from the beginning, just don't do it on squeeze plays, because they're not predictable. It's very dangerous. Brenda here says, I don't bet against AMC or risk my shares. I'm just trying to make more money. Yeah, she's buying calls.
Right.
So she's actually not betting against or risking her shares. She's actually risking cash. That's all she's doing. And that's pretty much it. I mean, a lot of people want to make them extra nickels and dimes on top of it to buy more shares, and that's all she's trying to do there.
But she said, when Spence, you said you can learn by paper or something. She wants to know, how do you learn it without, wasting her money, blowing her money. Go ahead.
Go to Thinkorswim on Google. It's a trading platform. Start an account. And then once you're started, you're going to see trade and paper trade. You're going to click. You don't have to put any money in it. It's free. You click on the paper trade button, and you can go in and familiarize yourself with that platform. And you can sell calls. You can sell covered calls, sell puts. You can buy puts. You can buy calls. You can practice with paper money, with fake money. You won't lose any real money, and you won't have to spend any real money. But like this, you could take Froggy's examples here that he put up for these stocks on these contracts, and you can go and type them in and see where they land on the expiration date, and it's going to give you an idea of how the options market works, and it's going to give you practice on how to place these trades and understand them.
Yeah, I think it's very useful to know this kind of stuff because it's actually very low risk.
Similar to Webull, right? They have that little paper thing going on too.
Yeah.
I'm not 100% sure you can do options on Webull though. I know you can trade stocks on paper trading, but I didn't see the options platform for that.
Yeah, I never went that far. I just knew they had a paper account there.
Let me see. Eric G says covered calls must have 100 shares. Covered puts must have the capital for 100 shares. Exactly right.
Isaac says selling AMC covered calls on a potential squeeze is not a good idea for beginners. Please use practice accounts, paper trading. Yep.
I've been smiling and laughing for the past 5 minutes because I read an article, Froggy, and it's off topic, but it's real quick.
Yeah, go ahead.
Citibank and Revlon.
Yep.
So Revlon's going bankrupt. Everybody heard that. They filed for Chapter 11 so they could restructure while they're trying to figure out what's going on.
What's going to happen tomorrow morning?
So Citibank, they said an employee made a mistake.
What?
They paid off $1.1 billion of Revlon debt to the lenders, which are hedge funds, right? And a judge came in because the hedge funds ignored Citibank's phone calls and said, basically, we're not giving you your money back. They paid off those debts 3 years in advance.
Holy shit.
Came in and sided with the lenders and said, no, Citibank, they don't have to give you your money back. You paid that debt off. But you know what it was? That was Citibank transferring that money to hedge funds who owned the Revlon debt because they needed it to meet margin requirements.
Wow.
Does that make sense?
Now,
so, go ahead.
Go ahead and finish that up because I was just about to say something about puts.
So they don't have to pay it back.
So basically, Citadel sent money to these hedge funds that own this debt with Revlon, and a judge came in and said, no, you don't have to send it back. We'll work it out another way. But to me, it looks like Citibank gave a bunch of hedge funds $1.1 billion, maybe so they could meet margin requirements, and we didn't squeeze out on some stocks.
Wow.
It makes more sense that way. Not some employee going, oops, I sent $1 billion out and paid a company's debt off. Sorry. So I just thought it was interesting. I sent you the article, Froggy.
That's crazy. At Brenda, that's Miss Harris.
All right, so what I'm looking at here is DWAC, and we're looking at a 10% markup on the strike price here, and you got $4,270. But that means you have to be invested in this company that you're not even sure is going to get a merger or be allowed to come fully public. So that's the one that you would want to play puts on, just because of the fact that you don't have to put your skin in the game. Investing in the 24 strikes at the current price right now would still yield you $3,500 for a week off 100,000.
One to the baño.
It'd still give you $350 for $10,000. So I think that right there looks like a pretty good investment. Is sitting in cash, selling a 24 strike put on DWAC for 1 week out. I think would be right now it looks like a very good paying play, because you got 21% chance of it actually going down to 24, which is still underneath that 30 threshold. All the advantages are on your side, so that's pretty much it. You could clearly make more if you went to the 25 strike, but that puts more risk, but you get $4,445. I'd stay at the 3,500 for a week. I think that'd be a safer bet. Berta says, do you teach step-by-step how to buy and sell regular options in Discord? We haven't got to the actual buying and selling regular options yet, just because there's a lot to it. And the thing I worry about is people not knowing how to day trade doing options, because when you buy really far out the money strikes, usually you hand somebody money and they pretty much keep it. It's basically what I'm doing here is selling premium, and then people buying them farther out options, they make me premium. So one of my targets for AMC would have been, actually I didn't do AMC yet. I'll do an AMC one here just to give you an idea. Okay, so we got AMC is currently trading at $12.35. $100,000 investment. Again, just for the ratio. That gives you 8,097 shares. Which is 80 contracts. And then if you did 10% markup, which would be $13.50. Let's see if we got that for a strike. %, delta, risk of not making it, which is, it's still pretty reasonable. What you're looking at is 80 times $35 a contract. And that's still $2,800. Which means DWAC is probably a better play, just because of the fact that the puts would probably make more money. But still, that gives you a pretty good idea. If you take a zero off of this, you take a zero off of that. So if you had $10,000 invested, it'd make you $280. But it's still the same idea. And again, it goes back up to where DWAC seems like a better play, because you don't have to invest in a stock. You can just put the cash up for collateral, and then you can still make your $3,500, which is a better pay, and it's a lower risk because your delta is only 21.8.
Hey Froggy, I gotta jump out, man. I gotta get the dog out and do all the what's today? Monday evening stuff.
Yeah, I'm about to wrap it up here, and I'm going to retouch back on this tomorrow. I do want to do more premium covering ideas, because I just wanted to get this out there that there's another way to make passive income. And I thought this was a really good thing. It keeps people from buying the options, because now you're the seller of the options and you're the one making the money. And playing 10% out is a pretty conservative number. And I think it's pretty fair for a weekly. You don't want to get too aggressive. It doesn't pay as much as buying a regular call, but it's a lot less risk, a lot less headache. I mean, you look at this DWAC play right here, that's 3.5% return. 3.5% return for 1 week is not bad at all, because you compound that over 52 weeks and you're way up there. So I would be even more conservative than this. 3,500 is just, I mean, I would back it down lower, maybe go with the 23 strikes. See if it gets you closer to like 2%, because 2% is usually what you want whenever you're doing something like that. And that's still pretty good money, because if you can get 2% per week on your money and it compounds, I think that's a really good way to invest. So, but hopefully that gives you guys an idea that there's another strategy out there, and you don't always have to buy call contracts to make money. You can sell them and still make money. It's not quite as much as you would want, but the risk level is so much lower. And if you're already holding on to the stock, it's money on top of your investment. So if you're already holding long, you can do it. And it's just an idea. And like I said, I'm going to be covering it all week this week. So we're going to be talking about covered calls, probably get into some more DRS and anything else that pops up in the market. So, yeah, that's pretty much it. Hopefully it does help you guys into getting ideas of what's going on here. But like I said, I think it's a good strat.
I would say if you're hell-bent on selling AMC covered calls, probably only do a position of or GameStop too. Probably only a small position, like if you have 1,000 shares, 10-20%. So that way you're still making some premium, but you're not going to miss out on any big runs. I'd say if you're hell-bent on doing it. So
yeah, there is the other option of taking another play, like Tesla, selling it and moving it to AMC and only using that money from the Tesla play for covered calls, because you weren't going to get the squeeze on that money anyways. And it does pay a little bit more than a Tesla, but in buying raw shares does kind of contribute to the play. So, I mean, but yeah, definitely practice with paper options on TD Ameritrade and Webull. And that's pretty much it. Please hit that like button if you do get a chance. And I will be back, like I said, tomorrow. We will be covering more of this. We'll be doing more examples and covering the market close as well. So I want to see people make some money, period, because I think it's instead of learning how to day trade, learn charts, just sell covered call, make that money, put it to the side, buy stock. As you gain another contract, you make more money. You're doing nothing, and you've already taught yourself the simplest way to make passive income. And I think it's way easier than day trading. So,
real quick too, before you decide to go do any of this, you got to make sure that your brokerage, your account is set up for the different levels in options trading. There's like level 1, 2, and 3. So if you don't see the ability to sell a covered call, you might not have the right level. Yeah. So just call your broker and then they can set that up for you.
I forgot about that. Every time I get an account, I go right to like the top spot on options.
Make sure they're not playing on margin either.
Yeah. Shouldn't do anything on margin, in my opinion. That's my personal opinion. You shouldn't do any investing on margin.
Can you buy Tesla on margin and get a 2-for-1, or did they already turn that off?
I don't know. Are you talking about the stock split dividend or the stock split they're talking about, or
just buying raw shares? Can you get 2-for-1 because of margin?
I don't know, because they raised the rates on everything so high with different brokers.
because of the situation the market's in. So I don't know what the minimum requirement that you have to have, if it's 10% or 100% that you have to be able to meet the margin requirements.
Because that's the only time that I would advise that you could do a margin account, as long as you keep your account separate from AMC, is if you're buying something like Tesla and you're getting a 2-for-1, you could sell twice as many covered calls, make twice as much money, and then you just pay the difference back. And it's a win-win for you. So, but that's pretty much it. I think I'm going to wrap it up here, guys. And then we'll get back into it tomorrow. Spence, you want to go ahead and wrap it up since you said you had to go first?
Yeah, I appreciate you guys having me on. That was a really good video. The roundabout, the community discussion, I think, is how people learn. So, Froggy, good on you for that. And Ape, I love your background there, man. You're all set up, looking nice. And guys, please follow these guys, like, sub, all that. And my show is always open, and it's an honor to be doing this with you guys.
Oh, it's nice having you on, man, because, like, I think you're pretty brilliant. You know what you're doing, so it's nice having you on. Because you could check me if I'm off. It's nice to say, hey, wait, I'm not always right on everything, and it would be nice to just have eyes on me to keep me in check if I make because I misspeak sometimes too. And, but I think we're going in the right direction here. I think any kind of passive income, it'd be so nice to see how many people will have like a ton of money in an account and they don't realize they could be drawing income off of it, which you don't really want the income. You just put it back in, keep buying more cheap stocks while the market's down, and it's a win-win for you.
Well, look what you did on a market close day, everybody's learning something instead of just sitting around not doing anything. So
I like to mess with the crypto after when the market's closed.
Oh yeah,
which I gotta say, it is a good day to have off, man. Juneteenth. Good things for Juneteenth.
Yeah. Shout out to Juneteenth.
What is happening to Bitcoin?
I think right now it's at 20.
Okay.
Citadel.
Last I checked, yeah. It,
it does have support down there.
Yeah.
Oh, what is that, a 1 month time frame?
Ethereum. Oh, it looks like it's going back down though, because I think Ethereum even went back down. It was at 11 and some change not too long ago.
You guys saw Citadel and Virtue are going to be making a crypto platform with Fidelity, correct?
No, I missed that.
Yeah,
this is institutional dumping. They've shorted the living crap out of Bitcoin, right? They do it to get the price down because now they want to be able to get in at bottom to build their new platforms.
Yeah.
The problem is if retail spooks out any further and they get margin called, which they might even be expecting that. If they get margin called and they have to close the shorts, now you have Citadel and Virtue in at the bottom of the market, it squeezes back up, and they own all this Bitcoin and Ethereum on their new platform, and they look like rock stars.
I would leave mine into a zero.
I on Bitcoin at 16,600. So I don't know if it's done going down, but I think it will probably touch a lower number at some point, and then you'll probably get your little double bottom, and then maybe a turnaround. But they brought it down hard. So yeah, thanks for coming, Spence. It was a pleasure. Guys. Have a good one.
Y'all have a good one.
Yep. Later,
right, too.
Ms. Harris, you want to go ahead and wrap it up on your end?
Yes. Want to thank everybody for coming, which is 8 versus Wall Street. He's always here. He's the co-host. 8 Radio, which is the one, the head, Viper, Jordan, Lady Katie. Thank all of them. The one stopped in. Spence and Jen. Thank them so much. And George, Mr. Donahue George. Thank him for coming in. Jevin came in. I see Mike, Shay, Jason, Justin. James is always here. He's always here. Even though he changed his picture to a dog, he's always here. Senior Master Sergeant Zach. That man shows up all the time. Blue Boy, appreciate you. Ducknator, all you guys. You guys are amazing and wonderful. Thank you guys for coming. Everyone, please go down to the stream, like and subscribe to Froggystyles channel, along with 8 versus Wall Street, along with Spence's channel, because they all do such great work. Appreciate it. And if you haven't already become a member, please help Froggy He wants to quit his job and become a full-time YouTuber, and that's what we all want. We all want that. So please go down there, become a member. It's greatly appreciated. I want to thank my guy, S.U. Ray. Love him. My guy, P.J. Sawyer. Spoke to him yesterday, doing good. He'll be back soon. Appreciate you. And always showing up in the space. I mean, in our chat is Kathy, Nelly, Ant Card. Ant Card here all the time like clockwork. Deppin's here all the time. Reaper Skinner. Appreciate you guys. You guys all rock. Now, if you guys know, as my son would say, do it up. We out. Hey, Shay. Shay, I see you up there, Shay. We out. So it's on you now, Froggy.
I'll leave it up to Apes to go ahead and add his.
All right. Thanks, everybody, for coming. Shout out to the Hedge, the One, Spence, Viper, Katie, Jen, and everybody that came through. Shout out to everybody in the comment. Peace, love, and bless. Thank you, Miss Harris, for killing the comment section. Thank you, Froggy, for having me. Peace.
Yeah, I want to do a shout out to Donahue George. He was here. I wish he would have stuck around because he's very knowledgeable about this stuff. I do know Casey Shaw was here for a minute. It'd be nice to get some more input from those guys because they know their stuff too. But we got the One, the Hedge. They'll be coming on in about 1 hour for Ape Radio. Definitely check them guys out. We got Spence. I want to thank him for coming by and adding in his 2 cents because it's always nice to have someone that knows what they're talking about too coming on and helping contribute to the community. And we got Apes and just trying to see who else we got here.
Please hit that like button on the way out, guys.
Opinionated. He's always here. And Miss Brenda came in too today. Brenda Queen of Swords came in today to represent. Appreciate her. He's always here, opinionated. He's here like, I don't know if it's he or she or whatever, but here like clockwork along with James. James up in space call here every day and opinionated. He's down there every day with Ant Card and all the rest of them. So yeah, appreciate him.
Yep, welcome Brenda for coming back. Sorry it took me so long to figure out that you were actually blocked. So
what?
Somehow she ended up getting blocked on both accounts. I did notice she made a second account to let me know that her first one was blocked. Okay. When I looked, it wasn't blocked. And then at one point, they both got blocked. I'm like, I have no idea how that happened.
Man, things be happening with these social medias, man. It's crazy.
So it popped up. I looked. I was sitting there thinking, I was like, man, I haven't seen CSI for a minute and Brenda for a minute. This is weird. Like, are they on vacation? So I went and looked into the block list, and I'm like, haha. Something weird happened, but yeah, hopefully that gets you guys started. Like I said, I'll be working on this all week to try to teach somebody how to make some money on selling covered calls. If you have any questions, feel free to stop in and ask because I think this is an easy way to make extra money without doing much of anything but just selling covered calls.
Yeah.
So.
Hey, Blockbuster, I hope you're doing better. That's the one I was telling y'all. He had COVID and pneumonia. Blockbuster.
Oh, yeah. Shout out to Hobby, too.
He had it. He still came here every day and listened, though. So appreciate you, Blockbuster. Hope Jobby's doing well. Mike G, 83, see you. Everybody, thank y'all. Even when Froggy was off. Well, he wasn't off today. He did have to work.
I appreciate that, Ant Card.
Today was a holiday. We appreciate y'all for all y'all coming in and stuck by. All y'all. All the time. Thank you.
AJ is going to be stopping by StockThatDip. He's going to be stopping by here one of these days to talk about covered calls because he does like them. And he does think it's a really good idea for people that don't know. Yeah. He thinks it's a good idea for people to learn because you don't really have to learn all the crazy stuff of the market.
Right.
All you got to do is learn if it's down, or if the stock's up. You always got to do is learn trend. That's the easiest thing to figure. And then you sell your calls. You can just buy, hold long-term, sell covered calls forever. And you're always either saving a loss or you're adding to a position. And either which way, it's a win-win for you.
Right.
And because if you're not doing anything while it's going down, you're actually losing all the money. But at least this way you can gain back 2%. And that offsets a loss. I mean, you could always swing trade it and do that stuff, but a lot of people don't want to deal with the headaches, and selling covered calls is pretty easy. You just add 10% to the price, look for the nearest strike, sell the covered call, and you sit back and collect the cash, buy more stock, and it's kind of that easy. So hopefully I helped somebody out here, and I will see you guys tomorrow. Thank you for coming, and peace.
Bless everybody.
If you smell what the frog is cooking.